네, 잠시
Let me make a short announcement. It is 1 p.m. right now, and from 10 past 1, we will begin with the 2021 KOBC Maritime Conference. I ask all of you to be seated, and we have the CEO here, so can I ask you to put your hands together? So shortly we will begin with the conference, and for our conference, please check your smartphone whether it's in vibration or silent mode. And the KOBC Maritime Conference will be streamed online live. For Korean participants, we will provide Korean simultaneous interpretation on Eventers, and for overseas participants, we have English translation on YouTube. If you are offline participating, please use the receiver, and we also have an online event. For the first 100 people, we are providing a coupon for sandwich and drink, and we also would like to ask for your participation in this event. If you click on the YouTube live streaming menu on the Eventers webinar page, you can access the conference on YouTube. And if you are here, please wear your face mask. We will begin at 10 past 1.
네, 다시 한번 안내 말씀드리도록
Let me make a short announcement. The 2021 KOBC Maritime Conference will be held online and offline. So we are streaming the event live online, and for Korean participants, we are providing Korean translation on Eventer's webpage. And for overseas participants, we provide English translation on YouTube. And if you're here offline, channel 1 is Korean and channel 2 is English on your receivers. So please use your receivers to listen to the conference if you need it. And for Korean participants on Eventers, thank you for pre-registering. And there is an attendance category on Eventers webpage. If you check your attendance there, we are providing gift coupons. And if you also join the questionnaire survey, we also are providing ice cream coupons. So I ask for your active participation in the events. So if there are any Korean participants who want English translation, you can click on the YouTube live streaming menu on Eventer's webpage. So please select the language of your preference. So in order to begin with the event, I would like to ask you to take your seats.
네, 여러분은 지금
So you are joining the 2021 KOBC Maritime Conference. Before I begin with the event, I ask you to check your smartphones, whether it's in silent or vibration mode. I'm the MC for today's event. My name is Jung-Ah Kim. It's a pleasure to meet with you. First of all, I would like to thank all the participants to the 2021 KOBC Maritime Conference, despite your busy schedules. Just like in 2020, we are holding this event online due to the coronavirus pandemic. And the contactless era, I think it's more desirable to be able to reach out to more participants online. This is the fourth round of the KOBC Maritime Conference that was launched in 2018 by the Korea Ocean Business Corporation. Today we are hosting this event to discuss the future and present of the shipping industry of Korea and overseas with experts. The theme for this year is post-pandemic, the path to take. We are going to discuss the today and tomorrow of the global shipping industry after the pandemic. It would be a valuable opportunity for all of us. I ask your patience until the very end. We have various sessions and presentations on diverse topics of the shipping industry, and we will also provide a Q&A section. Before we begin, let me introduce you to the Korea Ocean Business Corporation. Let's first watch a video introducing KOBC.
세계 해운의 판을 바꿉니다. We start a new era. KOBC. 해운 산업은 대한민국의 경제를 견인하고 안보를 지키는 우리나라의 핵심 기간 산업입니다. 글로벌 경기 불황의 파고에도 꿋꿋이 자리를 지키며 도약을 준비하던 우리 해운 산업은 이제 국제 환경 변화에 대응하며 위기를 기회로 바꾸고 있습니다. 더 크고 더 원대하게 글로벌 탑5 해운 강국 코리아를 목표로 한국해양진흥공사는 해운 산업의 판도를 바꿀 새로운 패러다임을 만들어갑니다. 2018년 해운 기업들의 안정적인 선박 도입과 유동성 확보를 지원하고 해운산업 성장에 필요한 서비스를 제공하여 우리나라 해운산업의 경쟁력 강화를 위해 설립된 한국해양진흥공사. 설립 이후 한국해양진흥공사는 해운정책 지원 사업을 통해 정부의 해운재건 5개년 계획을 실행에 옮기는 한편 해운금융지원 사업을 실행하여 해운기업의 선박 확충 및 유동성 확보를 지원하는 등 해운기업의 안전판, 선박 금융을 확대하는 해운산업 성장판, 해운 관련 정보를 제공하는 나침판, 더 큰 시장으로 인도하는 디딤판으로서의 기능을 수행하고 있습니다. 한국해양진흥공사는 다양한 정부 지원 정책을 제공함으로써 해운기업의 안전판이 되겠습니다. 이를 위해 초대형 컨테이너 선박 확충과 선봉량 증가에 대비한 컨테이너 박스의 안정적인 확보를 지원함으로써 글로벌 경쟁력을 갖춘 국적 해운선사를 육성하고 해운기업 간 자율적 통합을 위한 컨설팅 및 지원을 통해 경쟁력 강화에 기여하고 있습니다. 한국해양진흥공사는 차별화된 투자, 보증 사업으로 해운기업의 산업 성장판이 되겠습니다. 변동성이 크고 불확실성이 상존하는 해운산업. 한국해양진흥공사는 공사 자체 신용평가 모델을 도입, 중소선사를 비롯한 지원선사를 확대해 금융사각지대를 해소하고 선박금융 채무보증 프로그램으로 금융비용 절감을 통해 원가 경쟁력 확보와 민간 금융기관의 참여와 투자 활성화를 도모하고 있습니다. 또한 SNLB 사업을 통해서는 유동성 부족을 겪는 해운기업의 현금 흐름을 개선하는 등 선박 및 해운 인프라 투자 사업을 진행하는 선사들을 위해 지원의 폭은 더 확대하고 지원 대상은 더욱 다각화하고 있습니다. 한국해양진흥공사는 명확한 목표와 전략을 제시하는 나침판이 되겠습니다. 해운산업정보센터를 운영, 해운기업과 해양금융기관이 앞으로 나아갈 방향을 합리적으로 결정할 수 있도록 해운지식 기반 서비스를 제공하고 있습니다. 해운정보 허브로서 우리 해운기업에 적합한 시황 정보를 제공하고 인적 교류와 지식 공유의 장을 마련하는 것은 물론 선박 투자를 위한 선박 가치 평가 및 해운기업 진단 컨설팅 서비스를 통해 경영 안정 지원을 강화해 나갈 것입니다. 한국해양진흥공사는 더 큰 시장으로 인도하는 디딤판이 되겠습니다. 해운산업의 장기 경쟁력 제고를 위해 가깝게는 2020년부터 강화되는 국제환경 규제에 맞춰 친환경 선박과 설비 지원을 강화하고 장기적으로는 4차 산업혁명에 대비하여 해운 정보통신 기술의 융합 등 지속가능한 해운산업의 미래를 준비하고 있습니다. 한국해양진흥공사는 해운산업과 동반 성장해가며 사회적 가치를 높이고 공생적 산업 생태계를 완성해 나갈 것입니다. 위기를 기회로, 가능성을 추진력으로 우리는 바꿔갈 것입니다. 한국해양진흥공사는 최고의 해운금융 전문가들로서 세계를 무대로 활약하는 우리 해운기업과 함께 호흡하며 해운산업의 판도를 읽고 선도해 나가며 글로벌 탑5로 도약하는 해운강국 코리아를 이끌어 나가겠습니다. 대한민국을 중심으로 펼쳐진 해운산업의 새로운 판 위에서 한국해양진흥공사, 대한민국 해운산업을 다시 뛰게 합니다.
Yes, let's put your hands together for KOBC. KOBC has been striving in various sectors to strengthen Korea's shipping industry and also to achieve shared growth in the shipping industry. It has been turning crisis into opportunities and possibility into reality, and pursuing the vision of shipping powerhouse Korea. It is going to further support Korea's shipping industry growth. Before we begin, we're going to listen to the opening remarks by CEO Kim Yang-soo of KOBC to mark the beginning of today's conference. Let's put your hands together for Mr. Kim.
안녕하십니까.
Good afternoon. I am Yang-soo Kim, the CEO of Korea Ocean Business Corporation. I would like to sincerely welcome all the participants to the 2021 KOBC Maritime Conference. And first of all, let me extend my gratitude to Mr. Kim Tae-eum, the chair of the Committee on Agriculture, Oceans and Fisheries of the National Assembly, Secretary General Im Gi-taek of IMO, Chairman Jung Tae-soon of Korea Shipowners Association, and the speakers today. I would also like to extend my gratitude to the members of the shipping industry who have strived to rebuild Korea's shipping sector. We've been wisely responding to the unprecedented disaster called COVID pandemic. However, the protraction of the pandemic has been compounding the uncertainty of the global supply chain, and the new change presented by with COVID is a double-sided coin of hope and threat. The changed lifestyles and ways of thinking after the pandemic has been impacting various sectors, and the shipping industry is no exception. We are currently progressing toward transition into a green economy and digitization. These trends will continue even when we go back to normal, and this will pose a new challenge for all of us. Right now, there is a transition going on toward post-pandemic era. It is time we carry out multifaceted analysis on the future of the shipping industry and explore strategies and policy implications. And I hope the KOBC Maritime Conference provides a venue for analysis and also discussion for changes in this sector. Befitting the theme post-pandemic to the path to take, I hope this event is key to opening a new future tomorrow, and I declare open the 4th KOBC Maritime Conference. Next year, I hope we all can meet in person offline. Thank you.
네, 좋은 말씀 주신 우리
Thank you very much, Mr. Kim from KOBC. As Mr. Kim has mentioned, I hope this conference provides an opportunity for sustainable growth in the shipping industry, and I hope it becomes a meaningful event for all participants. And that was the opening remarks. And now we are going to listen to the congratulatory remarks by 3 distinguished guests congratulating the 2021 KOBC Maritime Conference. So we are going to watch 3 videos showing congratulatory remarks, starting with the chair of the National Assembly's Agriculture, Ocean and Fisheries Committee, Mr. Tae-eum Kim. Let's watch the video. Good afternoon. I am Kim Tae-eun, the chair of the National Assembly's Agriculture, Ocean and Fisheries Committee. I would like to congratulate you on holding the 4th KOBC Maritime Conference. I'm sure that The presentations by experts will strengthen the knowledge competitiveness of the shipping industry. Currently, the shipping industry is finding it difficult to secure ship space due to increase in freight. I hope this event proves as an opportunity to diagnose the current situation and also come up with response strategies to future challenges. And I hope next year COVID is terminated so we can meet in Busan in person. Thank you. Backhand, please, for Mr. Kim. As Mr. Kim has mentioned, I hope we can indeed meet in Busan in person next year. And this next we have a congratulatory remark from faraway UK. It will be done by Secretary General Im Gi-taek of IMO.
안녕하십니까.
Good afternoon. My name is Ki-taek Lim, the Secretary General of the International Maritime Organization, or IMO. First of all, let me congratulate you on holding the 4th KOBC Maritime Conference. And I would like to thank KOBC and CEO Kim Yang-soo for inviting me to this prestigious event. Due to the unprecedented disaster called COVID-19, the shipping industry has been overcoming this difficulty, making a new leap forward. And at the center stands all of you who are participating in this conference. Shipping industry in the future is not just about transporting goods and services. It will have to focus on inheriting a clean environment for our next generation. IMO has adopted EXI and CII for sustainability. In the initial stage, efforts for marine environment protection can feel difficult, but if we gather our wisdom, I believe that coexistence of the mankind and nature will be possible. I'm sure that the presentations given by experts in the shipping industry in this KOBC Maritime Conference will provide a new milestone for Korea's shipping sector. This year also, I hope the insight of the experts and enthusiasm of the participants could create a synergy effect to create an active discussion on this sector. Due to COVID-19, it's regretful that I could not be in Busan where you are, but I hope we can meet in person next year. Let me once again congratulate you and wish for a successful event. Thank you. Thank you, Secretary General, for that warm remarks. Thank you. The last congratulatory remarks will be given by Mr. Jung Tae-sun, the chairman of the Korea Shipowners Association. Let's watch the video. Distinguished guests, ladies and gentlemen, I would like to congratulate you on holding the 2021 KOBC Maritime Conference. Korea was a latecomer in the shipping industry, but thanks to the rationalization of the sector in 2018, and after the global financial crisis in 2018, we have been going through a lot of challenges. But in the same year, there was a big turning point for Korea, which is none other than the launching of the KOBC. The successful revival of HMM showed that KOBC is indeed a game changer in the sector. And I would like to divide the history of the shipping sector of Korea before and after the establishment of KOBC. With KOBC supporting us, I believe that we will be able to achieve the vision of building Korea as a global shipping powerhouse. I would like to extend my gratitude to the government and the public for your support to KOBC and wish for the development of KOBC and have the success of the CEO, Mr. Kim Young-soo, and employees. Thank you. Thank you very much for that great remarks. He has highlighted our efforts toward realizing the dream of the #1 shipping powerhouse in the world. And that were the 3 congratulatory remarks. And now we will listen to the presentation of experts in the first session. First of all, we will listen to the presentation on the current status and outlook on the shipping industry, moving on to the market situation and outlook on dry bulk carriers, and then on to oil carriers. After the 3 presentations, we will have a Q&A session to entertain questions live with our Korean speaker. And as for overseas speakers' presentations, we won't be able to entertain the questions live, but if there are any questions, we will collect them, and we promise you that we will get back to you as soon as possible. I'm sure you have a lot of questions, so please feel free to ask your questions during the Q&A. And if you leave your questions on YouTube, we will select the questions to cover them. Now we will begin with the first session.
해운
So, with the title of The Trend and Prospect of a Maritime Industry, General Manager Jung Young-do of KOBC will deliver the first presentation. Please give the speaker a big hand.
예, 다시
Let me greet you again. My name is Jung Young-do. I am the General Manager of KOBC. So at the Maritime Information Center, since 2020, we have been carrying out diagnosis projects on the maritime industry. The aim is to prevent the maritime crisis and to improve industrial competitiveness so that we can analyze the competitiveness and we can identify the industry's problems and improve the current situation. And in this presentation, I will share the research outcome, and I have 2 parts in the presentation. First, let me talk about the general ideas in the maritime industry of Korea, and in part 2, I will talk about key changes we are witnessing this year. I will talk about the reason, and I will also share the outlook, and I will also talk about the direction we will take to respond to the current problems. First, let me begin with the diagnosis of the maritime industry. We have 4 factors in competitiveness. First one is fleet competitiveness. We need to have great ships in the fleet. So we diagnosed the fleet competitiveness of Korea, and I also looked at cargo volume. The national carriers are showing changes in that field. And third, we have price competitiveness and or cost competitiveness. And if we have cost competitiveness, we can make more money in the peak season and we can endure the low season. So we looked at the status of cost competitiveness in Korea. And I also looked at investment level in virtuous cycle. So how we are securing ships in a proper time will be the focus of the first item. First, let me talk about bottoms of our ships. So we compared the number of ships in the controlled fleet, and compared to 2016, there has been an increase in the number of ships in 2021. So you can find the data in the chart. So in terms of ISL, the national flag of Korea is ranked number 4 in the world. So there could be a different ranking by organization, but this is the data from ISL. When we look at the vessel value, Korea is ranked about fifth. And when the criteria is UNCTAD, Korea's ranking is number 7 in the world. So first, Korea's fleet is ranked the 4th in the world, but when we look at our competitor, which is Japan, although Japan is number 3, we have a huge gap with Japan. The bottoms in Korea is only 1/3 of that of Japan. So we still lack the number of ships in the fleet. And second, when we look at the fleet in Greece and China, they are expanding the fleet very rapidly. So we are witnessing a wider gap with these countries. And Korea, we can compare Korea to Germany. Compared to 5 years, Germany's bottoms have decreased, but Korea saw an increase. So that's why we could catch up with Germany. In case of Germany, there are similar points with Korea. And Hapag Lloyd is the major shipping line in Germany, and they are competitors with Korean shipping lines. But KG Fund in Germany accounted for 60 to 70% of the global maritime fund. However, since 2012, the finance in Germany decreased, which led to the decrease of bottoms. But after the crisis of Hanjin shipping in Korea, we carried out various policies so we could maintain the bottoms. That is why there was the change of ranking between Korea and Germany. So the implications are that finance is very important in the industry. So when we look at the quality of bottoms, we can look at the average vessel of the controlled fleet. The average vessel of age of controlled fleet in Korea is about 14 years, and it is similar to the global average of 15.5 years. When we compare with competitors, compared to Japan, China, and Greece, Korea's vessels are a little bit older. So to increase bottoms, we need to secure more new builds. And to secure the quality of bottoms, we have to convert to eco-friendly vessels, and we need to accelerate the change. So let me move on to the cargo volume. It is also a very important item, and for Korean carriers, we need more cargo volumes to have a favorable situation. But when we look at the bulk ships and container ships, there is a difference. So on the left side, this is the cargo volume of a dry bulk, which includes wet bulk and gas as well. But the import of bulk in Korea is number 4 in the world. It is quite huge. However, the problem is that the import of bulk cargo is decreasing in Korea. And the biggest decrease comes from coal, because we are shifting toward carbon neutrality, and we are not using coal as much as before for power generation. So based on long term, we could benefit from coal transport, but the profit is decreasing for Korean carriers. So in response to the current situation, Korean shipping companies should look at China and Southeast Asia, so we can have a trilateral trade with these regions, and we can supplement our current policy. And for container ships in the first half of this year, so this is the cargo handling volume of major ports. In case of Busan Port, in the first half of this year, it was about 11.42 million TEU. it was an increase, but Qingdao port's handling volume increased even further. So we became global number 7 from global number 6 before. So in Shenzhen and Ningbo and Shanghai, Tianjin, these major ports in China are Korea's competitors, and their handling volume is increasing drastically. So for Korean shipping companies, the situation is not that favorable. So we have to secure more transshipment cargo so that we can help Korean companies secure more profits. So let me talk about cost competitiveness. And my center looked at major companies in the market, and we looked at the operating profit of major shipping companies. And container shipping companies showed an improvement, the biggest improvement in operating profit, and their financial structure has gotten better as well. However, we need to conduct an in-depth study on our cost competitiveness. I believe that there was a huge impact recently, and we made a comparison of Korean shipping companies with competitors. So in 2019, Korean companies' operating profit was about 1%, but COSCO and other competitors, they recorded 15%. So SCFI was 811 points, but Korean companies had BP points. So I believe that other countries' shipping companies had a lower SCFI. So the cost competitiveness was very low for Korean companies, but the situation has changed this year. So for Korean shipping companies, we surpassed the operating profit of COSCO, and we are still lagging behind Evergreen. But in the same market situation, I believe that Korean companies are garnering even higher profits. That means that we have recovered a certain level of cost competitiveness. And why is that? Korean shipping companies have secured large vessels before the vessel price went up. So the proper and timely orders resulted in this favorable outcome. So let me move on to the new building investment. So it is about finance. The biggest problem of Korean shipping companies was that they invested in the vessels when the ship price is too high, and they did the opposite when the vessel price went down. So they went contrary to the trend, and the problem was related to the finance, but financial institutions helped Korean shipping companies so that we can build a virtuous cycle. And when we look at the new building investment, the new build price was bottomed out in 2020, and this year it showed a steep rise. So we are investing more in new building, and China is expanding the investment in new builds. And Greece is also maintaining the level of investment here. In case of Korea, in 2019, there was a increased investment in dry bulk ships, but there was a decrease in 2020. But this year, we are looking at an increasing level of investment with a focus on container ships. And before the vessel price went up, we expanded the investment, so it was a great decision. And in 2020, it was quite unfortunate that Korea invested less. However, there is no order for dry bulk ships. So for the past 2 years, there were only 2 orders for dry bulk ships. So if this trend continues, as I mentioned in the controlled fleet, the bottoms will decrease or it will go flat. So this is a little bit concerning. And let me talk about the investment in second-hand vessels. When we compare Korea to competitors, we are not investing enough in second-hand vessels. And this year, up until now, compared to Greece and China, where more than 300 second-hand vessels were purchased, in Korea, the number of vessels acquired was only 32. So there will be an even wider gap in the controlled fleet with Greece and China. So Korean shipping companies are reluctant to buy second-hand vessels. So KOBC is carrying out a project where we purchase quality second-hand vessels so that Korean shipping companies could tap into those vessels. So the KOBC is supplementing the current situation through our projects. The third method to secure ships is charter. So there are new builds and second-hand vessels, and the third method is a charter contract. And in terms of the charter market, we made a comparison with competitors. So we have a dry bulk and container ship contract. So for dry bulk, we collected data for contract longer than 1 year, and BDI tripled compared to last year. But other competitors, such as Oldendorf and Cargill, they are maintaining the level of a charter contract. However, in case of a Swiss Marine, they are decreasing the charter contract drastically. So Oldendorf, Cargill, and Swiss Marine, they have much information on the market, but they are taking a different direction. And in Korea, there are not many charter contracts, but this year we are seeing an increasing number of charter contracts. So BDI showed a steep rise, and it is decreasing recently. So short-term, so it is dangerous to sign many charter contracts in the short term. That is why we need to manage risk related to freight rates, and we need to respond to the market volatility in a more flexible manner. So we need more short-term strategy for charter contracts. And in case of container vessels, as CFI increased 5-fold, and most of the shipping companies are having less and less charter ships. And MSC increased the portion of a charter, but most of the shipping companies are decreasing the portion of charter, and Korea is doing that very fast. And for a container ship, there was almost no container ship charter contract this year. What is the reason? The charter rate increased steeply, so it is hard to sign a contract. And ship owners are reluctant to sign a long-term charter contract. So when we look at the outlook, in October, we reached the tipping point. And when we look at the charter rate or freight rate, the rates are decreasing. However, when we sign a charter contract now, it will relieve the nightmare we experienced in the past. That is why we need to be careful about container ship charter contract, especially right now. So let me summarize part 1. So in the diagnosis, I mentioned 4 items. First, for fleet competitiveness, we are having more and more ships. However, competitors are having even more ships than us. So about cargo volume, we are maintaining the current level. However, we are seeing a slight decrease. So the environment is not favorable. And for cost competitiveness, the competitiveness in the container ship has recovered. And for investment, thanks to the help of financial institutions, we are building a virtuous cycle here. So now let me talk about the current status and prospect. And in the maritime market, there are 4 key changes. First, there is an increasing level of market volatility, and there is a steep rise in vessel price, and there is a competition for new building orders now. And fourth, there is a fierce competition for intra-Asia route market share. And what is the prospect in this situation, and how can we respond to the current status? So let me start with market volatility. So there are 2 reasons behind market volatility. It means we have higher risk in the market. So we need to manage risk related to market volatility. And second, shipping companies are generating profits. However, before it was based on cost competitiveness. However, in the future, the profit will be dependent on response to market volatility. Now that we have a higher volatility, we have to look at the direction of changes. So let me divide into dry bulk and container ship. So compared to before, there is a huge change in the dry bulk ships, and it goes up drastically and it goes down steeply again. So it is the pattern in dry bulk ship. So what is the reason? Globally, the fluidity is increasing, and there are many connected problems. And in case of a dry bulk ship, there was a prolonged slowdown, so there were very small number of new building orders. When we look at the prospect, it is different by organizations. And after COVID-19, there is a prospect to go back to 1,000 point, but some organizations say that the volatility will remain even after COVID-19. And we have carbon-related regulation, and there is a still small number of new building orders. I believe that there will be a high volatility in the future as well. And how can we respond to this? Market volatility risk management should be reinforced by shipping companies. And at the KOBC, we have conducted analysis on risk related to charter contracts, and we are providing consulting services. So you can utilize the consulting services we are providing, and you have to manage the fleet flexibly. And when there is a huge volatility and fluctuation in dry bulk, you shouldn't concentrate in one position. So you have to balance the long and short positions. So that is the strategy you need right now. In case of container ship, the fluctuation is increasing. So there was a pattern of going up and down in dry bulk, but for container ship, it is continuously growing. So what's the reason? There is a lack of containers and boxes in the market. So the market has already lost the control over demand and supply. So we have many short-term variables, and the container ship market has reached the tipping point. The fluctuation and volatility could go up further. However, if it is adjusted, we are at a crossroads between the soft landing and hard landing. So if you are confused, you can step back and look at the changes in the market. So you can wait and see. And the biggest short-term variable is the congestion in the major port in the US and lack of electricity in China. We have to look at what is going to happen regarding these factors. And after the logistics crisis, we are seeing a stronger relationship between shipping companies and cargo owners. So the KOBC will reinforce the collaboration by issuing the related certificates. And there has been a steep rise in vessel price. I talked about charter rate and freight rate. It is changing fast. However, the vessel price is changing fast as well. So there is vessel price risk, which is very important right now. And in the market, there is a signal for the overheated market. So when we look at the dry bulk first, in 2021, the new building and second-hand prices went up steeply because of the steel price rise and the increase of charter rate. So more and more companies want to buy ships. But for prospect, the freight rate for dry bulk is decreasing steeply, so the vessel price could go down accordingly. The KOBC is announcing the vessel price index, so you can look at the changes in the vessel price very closely. Because if you make a bad decision, you will face the cash flow problems. So when the vessel price is going down, you have to check the vessel price more often. And for container ship, the second-hand price is going up too fast. It has already surpassed that of new building price. So it is even 60% higher than that of the new building ship. The freight rate and charter rate have increased too fast, and it has resulted in the fast increase in second-hand market, and it is signaling the overheated market. And you might remember the situation in 2018. And container ship freight rate is going flat, so it is not increasing since October, and the charter rate is going down as well. So the vessel price is going on, but we have to respond to the potential steep decrease in vessel price here. And if you contract container ship second-hand vessel right now, you might face burden in the future. So you have to be careful about investment in second-hand vessels, especially container ship. So KOBC is closely monitoring the vessel price changes as well, and we can share the data with you. So let me talk about new building orders. So it is different in dry bulk and container ships. When the market is better, new building orders are increasing, and the market is down, the number of orders going down as well. However, in case of dry bulk, the market is getting better. However, still there is a low number of new building orders. I believe that is because of the reinforced regulation on carbon emissions. So they are thinking about what kind of technologies they have to implement, whether it is LNG, methanol, ammonia. They are lost right now. That is why ship owners are reluctant to invest in new building ships, especially in dry bulk. So when we have a clear direction about eco-friendly technologies, there could be a concentration of orders, new building orders. In that case, it might be hard for Korean companies to issue orders. So to complement such a situation, we have to reinforce the relationship with Korean shipyards. So dry bulk ship, Korean shipyards have less price competitiveness compared to Chinese shipyards. So we can look at the reference vessel type and so that we can decrease the new building price. So it could be one type of collaboration between Korean shipping companies and shipyards. And for container ship, there is a drastically increasing number of orders. So it is already about 3.9 million TEU with a focus on large vessels. So the number of ships ordered is 470, which is much higher compared to last year. In 2023, all of them will be delivered together. In that case, it could face a problem of oversupply, and it could lead to a prolonged slowdown in the market. However, in 2023, we will see the EEXI. So there is a huge uncertainty in the market. So based on cost competitiveness, we have to respond to this issue. That is the only option we have got. And we have to accelerate our transition into eco-friendly ships. Lastly, let me talk about the intra-Asia route market share. So when we look at the container ship market, Korean shipping companies were the strongest powerhouse. However, there are rising competitors in the market. So in intra-Asia route, compared to last year, the input bottoms increased this year, and the bottoms increased about 10% this year. So it means that there is a higher competition. And we have competitors from Swiss, China, and Taiwan. They are increasing their share. So they are taking away Korean shipping companies' portion right now. And what is the reason? Korean companies are using interim ships. So we are dispatching our ships to over ocean-going trade. That is why our market share has been eroded. So we are coming up with countermeasures to this current situation. So let me talk about the maritime information service we are providing at the center. So we provide maritime information such as the freight rate and the business evaluation. And in the peak season, cost competitiveness is important. And in low season, we need to reinforce our capacity to collect information. And currently, only one shipping company has a research team, and in other countries, they have quality research teams. In case of Ollendorf, they have 16 professional researchers. It is good to work hard. However, we have to set a proper direction. That is very important right now. So the KOBC will try to improve the information collection capacity for Korean shipping companies. So please use our capacity by tapping into information we provide. Thank you very much.
다시 한번
So it was the first presentation by Mr. Chung Young-do from the KOBC. Please give him another big hand. So he talked about the trend and prospect of a maritime industry. So if you have any questions, you can leave the question in the eventers Q&A section or YouTube channel. And we will have a Q&A session at the end of this after other presentations. Now we are here at 2021 KOBC Maritime Conference.
전망
Now we will move on to the next presentation on dry bulk freight market review and outlook by Dr. Derek Langston. Let's watch the video.
Good afternoon, and thank you to KOBC for the invitation to SSY to discuss the dry bulk freight market with you in such an extraordinary year as 2021. My name's Derek Langston. I'm the head of research at SSY, and today I'd like to discuss just how extraordinary this has been. 13-year highs for the dry bulk freight market in all sectors. The strength from the smaller sizes, in particular the influence of container ships, even more extraordinary, and all this while the global pandemic is still sweeping parts of the world. Today I will also discuss with you the positives and the negatives in terms of the outlook. We have a slowdown in Chinese steel production currently underway. We'll discuss the implications of that for next year, as well as fleet developments before moving on to our conclusions. So this first chart, taking the Baltic Exchange average TC rates, as you can see here, this extraordinary year very much the highlight of the chart. In particular, I'd like to draw your attention to the bottom right-hand corner of the chart, this white triangle that you can see there, with the Supramax and Handysize rates really supporting the larger vessel sizes. When we look in a bit more closely in the relationship between the smaller and the larger sizes, we just had an extraordinary spike in the Capesize market to over $80,000 a day. But if we take that in relation to the smaller sizes by using an earnings ratio, taking the Capesize 5 TCs, just dividing that by the Supramax 10 TCs and coming up with a ratio there, you can see that that recent spike by historical standards was nothing spectacular. In fact, in a lot of ways at the moment, the Capesize market for this time of year is roughly, as we speak towards the end of October, is at roughly at parity with the Supramax rate. Now, if taken in the longer term picture, you can see in fact that 2021 has been an underperforming year for the Capesize market. So much of the strength of this year has really been in the Supramax and the Handysize sectors. Then taking the seasonal view, this time we're using the Panamax, the 82 series there, just to give a Capesize Panamax earnings ratio on a January to December basis. And this chart is, again, it is extraordinary. Try not to use that word too often in this presentation. You can see there that for the first half of this year, 2021 in red was actually very, very similar to previous years. This is the only chart, really, that does have that. At the beginning of the year, of course, the soaring rates across all sizes completely broke out of the pattern that we've seen for the last decade. This chart, however, showed the Capes and the Panamaxes pretty much the same relationship that is normal. Then during July and into August, you can see there that the Capesize market underperformed the Panamax sector. And in fact, it's only recently that you can see that the Capes mirroring the ratio that we saw in 2020 with that recent spike. Now that recent spike, of course, coincided, yes, with more spot iron ore cargo availability from Australia, but mainly Brazil, at a time when the inflow of dedicated and spot tonnage into the South Atlantic was getting very thin. So those created the preconditions there for a spike. But now we see the Capesize market correcting downwards very strongly. And as we enter the final 2 months of the year, you can see there that the Capes actually underperforming the standards of the recent years. Now, looking back, you can see that there has been some downside to where the Capesize market has been through November. In particular, if we look there at 2018, we can see that we've had a lower level still. In 2019, a stronger level for the Cape. So there really isn't a particular strong seasonal pattern there for the end of the year. But we would point out there that in 2019, we did see some quite severe cuts in coal imports into China, as well as a bit less in the way of nickel ore exports from the Philippines into China. So for the Panamax and Supramax sectors, this particular year did suffer a bit of a cargo loss, and that helped the Cape-size market have that stronger ratio, that stronger relative strength against Panamaxes. But as we enter it, it is very interestingly poised. Then looking at the other commodities across the dry bulk sector, including crude oil there, and we can see in this chart we've indexed the prices at the beginning of 2018. Now this gives us a really long-term perspective of what commodity prices have been doing in the last few years. And for much of 2021, you can see that general positivity of demand returning after the worst of the lockdowns in 2020. So this chart there is just showing a generally quite a positive trend through much of this year. But we would argue that now it's beginning to get a bit too hot in terms of some of these prices. In particular, the steam coal price there that you can see, the second highest on this chart, getting particularly strong. And similarly, it's chasing the LNG price higher. So the prices of nat gas and steam coal adding input costs into end users. And we're starting to see demand destruction. You can see it in Europe. Some steel mills in Europe, particularly electric arc furnaces that are higher consumers of energy than blast furnaces, actually stopping operations or introducing surcharges to cover the high costs of energy. We also know that in India, some of the coastal power plants have, again, because of the soaring coal prices, wound down operations, just becoming uneconomical for their electricity generation. And you've actually seen that power plants inland that are using domestic coal have been increasing their output to counter. So that's been a negative for coal imports into India as well. And also in China, we also are aware of factory closures, suspensions of operations just because of the soaring costs of energy. So we are very conscious of this. This generally has been positive. The rate of increase for fuel costs is getting extremely high. So that is an area that we'd like to flag up of potential negative risk. So what are the reasons then for the freight market strength in 2021? Well, first of all, it's been very much led by the smaller sizes. And in this regard, the Pacific has been at the forefront of this activity. Some of that has been through Chinese steel exports. It's been fairly strong early on in the year, as well as fertilizers. Both of those cargo flows have suffered, are being discouraged at the moment. And so we're seeing that less activity from China away from the region. Earlier this year, of course, we saw more in the way of Indian iron ore going into China. That again is, we're seeing less of that in the second half of the year, but also strong volumes of cement, Indonesian coal, and also nickel ore from the Philippines. So there have been some very strong positive stories there. And the rebound in Australian wheat after 2 years of severe drought has also boosted activity in the region. We add to that long-haul trade growth, particular for the grain markets, the coal markets in particular, and so there have been some Cape-size inroads into the Russian, South African and US coal trades. With Russia, we're talking about the new facility at Taman in the Black Sea, which has been shipping into Asia. We would, of course, know that really, as we want to demonstrate in this presentation, that the supply and demand fundamentals, looking at those just by themselves, don't explain the whole story. It's the role of the fleet inefficiencies, in particular congestion that we've seen across recent years, but also those caused by quarantining and complications arising from crew change requirements, increased ballast legs. For example, if you're looking to load in Australia and New Zealand, and the very COVID-sensitive countries such as those, and the preference has been to take tonnage from further and further afield. Also, as well, when you're looking at quarantining of 14 days into part of China. Then for the short haul business from, say, Indonesia or the Philippines, that's been added significantly more sea days than was necessary. So it really is a factor of increasing days being taken to complete these voyages, the extra complications. That has been one of the critical factors then in tightening supply tonnage, because when you look at the demand picture, yes, we have growth this year around 3%, but that in itself does not explain the extraordinary gains that we've seen in the freight market. And then, in addition, we've had the extraordinary influence of the container market, in particular the shortages, pushing more cargoes onto bulkers. Now, this can take the form of both containers, as we know, being added on to dry bulk carriers, but also cargoes that were intended for containers that are being decontainerized and going onto bulkers. So as well as adding cargo onto this, which of course is very difficult to quantify the exact numbers that have come through this as a result of the container ship market, certainly adding cargo, it's also made the fleet less efficient. In particular, for example, in cases where you have a cargo of aluminium ingots taking up one hold of a 5-hold vessel. So a massive loss of capacity for the duration of that voyage. And even if you're adding containers onto, say, even a box-shaped vessel, there is also, that's running at less capacity than would have been the case if it had been carrying bulk trade. So this factor and the fact that the container ship market seems robust, and there'll be more from this at the KOBC conference in later presentation. But these, of course, are crucial factors in explaining that strength in the dry bulk market, and particularly coming from the smaller sizes. A couple of quick charts then, just to demonstrate what's been happening this year. If last year was about the strength in Chinese steel production and demand, this year has seen the world outside of China catching up. And indeed, more recently, we've actually seen some of the encouragement from Chinese policymakers to reduce Chinese steel production and hold it at 2020 levels, having quite a severe negative effect on production levels. On this chart, we can see the largest annual decline for China in over 25 years being recorded in September. We're looking at iron ore exports from Brazil. Yep, seasonally more export availability, and that's been helping the Capesize market, but it does really need to coincide with a lack of ballasters. At the moment, we're seeing more ballasters arriving from the Pacific, and therefore that any kind of activity there, we're seeing the tonnage balances tilt and rebalancing of the market. When we're looking at Chinese coal import sources, again, another remarkable development this year is the continuing avoidance of Australian coal by Chinese buyers. We can see there in this chart that red for Australia fading out, the increase in black from Indonesia. And this chart does include lignite, but also some of the longer haul voyages. I mentioned there Tamat, Russia, Murmansk, you can see there as well, but also from Colombia and South Africa, and indeed from North America. Some of those cargoes there strengthening a lengthening in ton-mile demand. On the grain side, we had recently had the immense disruption caused by Hurricane Ida on the US, but now we can see that volumes there are getting back to where they normally would be at this time of year. And this chart also really demonstrates the extraordinary growth in US corn exports, with China featuring more prominently than before as a result of this animal feed demand. And then finally, the container ship market. When compared with the handy-sized bulk carrier market, you can see there that the container ships, the pickup towards the end of last year for the container ship market, and then the handy-size earnings following that upwards. And at time of speaking, it seems that there's no real abating in the strength of the container ship market. So the positives then for the rest of the Q4 and into 2022 would be as follows. We are expecting a severe winter across Northeast Asia and indeed in Europe. So that does imply coal import potential from China. The big if with that is if supply is permitting. We've had some constraints from Russia, from Indonesia recently, South Africa as well, and also the US. So the demand is there, really is a question of supply availability. There are restrictions, as we've seen, quite heavy restrictions on this Chinese steel sector, particularly targeted in September. Enforced production cuts, yeah, that does create a potential for a rebound at the end of the year, but of course, we have anti-pollution measures in place and also the Winter Olympics in affecting Hebei province, for example. That would be in February, and extending the pollution restrictions until March. So there is scope for a rebound in steel production in China. The question is when. Front haul trade drivers, if we look at the grain markets, coal, as I've mentioned, and also iron ore, those would count as key positives. And as we're going to demonstrate, steel demand outside China would be one of those. Container shortages, there seems to be no sign of that easing anytime soon. And once again, we would stress the importance of fleet inefficiencies. And when we get closer to 2023 with the IMO, and again, that's something else you'll hear more about in this conference from KOBC, there's the potential for more slow steaming by non-compliant sections of the fleet in order to comply is there as well. So with those measures due to take effect, then fleet inefficiencies is something that we can expect to see in future years. And by historical standards, the order book remains relatively low. So looking at China's coal import dynamic, and in red we have the domestic price from IHS of steam coal from the Xinhuangdao FOB price. And we can see there that historically there's been a good relationship between import levels and domestic prices. At the moment, of course, we are leading to a real supply squeeze, both domestically and in terms of overseas. So we'd still look at this as a positive for import demand, but remain conscious on supply. We're looking at steel prices in China. Interestingly, they've remained relatively stable. When you compare that with the rest of the world, you can see there are massive gains in the US, where import tariffs are in place and an infrastructure bill is due to be signed. For US steel imports, this has been a positive, as you can see in this chart here, quite a pronounced upturn after a severe decline towards the end of last year. And when we look at the World Steel Association's short-range outlook for steel demand, this was done from October 2021. And you can see there that looking at 2022 forecasts there for India, Europe, there are actually some fairly large numbers still in place. For Japan and South Korea, less so, but you've seen a good increase in steel demand already this year. But yeah, this for the rest of the world outside of China, yeah, this is still relatively positive for 2022. Less so for China. Quite an extraordinary turnaround there. You can see a contraction of minus 1% for China expected in steel demand this year, and then flat growth in 2022. So there we have a bit of a difference of opinion, different divergence in outlook. For the grain markets, relatively positive. We see tentatively positive for Brazil and soybeans next year. There's a lot of weather to come around, of course. And also another strong crop from Australian wheat, and that again will be a feature with even more Australian wheat expected to be exported in the Pacific next year. The negatives for this quarter and beyond, as I mentioned, cargo supply shortages. That seems to be one of the main constraints on coal at the moment. And really the Capesize market potential to increase will be dictated by, of course, iron ore demand, but also the ability, for example, in Brazil to produce more iron ore cargo. The China slowdown, we've seen that already taking effect in steel, and of course the potential for that to become longer lasting and a disorderly default by Evergrande, for example, it's got to be one of the higher profile risks there as well. But of course that sort of easing and sort of softening of end user demand in China would remain one of the negative risks for next year. Our base case is rather similar to the World Steel Association, that kind of expectation of fairly flat demand growth in 2022. We've also highlighted the risk, and we're already seeing this, of demand destruction from surging commodity costs. And I guess this would be something to monitor if we have more in the way of risk of stagflation from inflationary costs while economic growth isn't rising. That would be more negative. We'd have to put that into our base case. There's a scope for more efficient fleet utilization if there's less COVID-related disruption. So a return to normality, that would, of course, increase fleet utilization. It would be a negative. However, really at the moment, this is such an important point to make about the dry bulk freight market. There doesn't seem to be much easing in prospect at the moment in terms of COVID-related quarantine measures. And in the longer term, a structural slowing in global seaborne coal trade growth. So looking at the apparent steel consumption in China, and already we can see the impact of this. This chart shows the impact of anti-pollution restrictions in the Chinese winter, as you can see there, creating a trough in the winter and then a bit of a peak through the summer. And what we've seen in 2021 is a break from that. Really, from about May, the peak of May onwards, there's been quite a sharp retreat from 95 million tonnes in May down to 70 million tonnes apparent steel demand in September. So already seeing that impact. Now, we haven't really seen a big impact there on the freight market because iron ore is that seasonal availability still being bought. It's still growing in terms of trade. What will be interesting to see is we get a build-up in iron ore port stocks. This chart that we have here shows the port stocks there in the kind of brown colour, and then the iron ore price in red. So often you get an inverse relationship. If the price is high, then stocks tend to get eroded or fail to grow. If the price is lower, then there is scope for those stocks to rise. And we have picked up a bit of an increase in port stocks within China in the last few weeks. Net growth in 2021 is expected. As you can see there, another strong year for growth. Very little demolition outside of the Capesize sector. And we are aware that in terms of new building orders, compared to this time last year, we're on course for a doubling in terms of new building contracting. This chart shows those numbers there in blue, but it also shows the Baltic Exchange Dry Index in red. And it's interesting to note that at this stage of the cycle, where the Baltic Exchange Dry Index is pushing higher, it's interesting to see that historically, even now, the new building contracting is lower than at previous stages in the past. So you can see there quite clearly this impact of uncertainty towards over the optimal vessel designs of the future and the viability of those as well. So a couple of quick charts then on the fleet. As you can see here, we have the Capesize fleet, a lower year in prospect for new building deliveries in 2022. But that order book as a proportion of the fleet, around 7%, historically very low. For the Panamaxes, you can see there the Kamsarmax orders, and 2022 again is maybe quite a similar year to 2021, but you can see there that it does tail away in 23 and 24 at the moment. Order books around 8% of the fleet. For the Handymax size, which includes Ultramaxes and Supramaxes, a steep decline there in 2023. These are scheduled deliveries, not our expectations, purely scheduled. And similar for handy sizes, from 10 to 40,000 deadweight. And in this case, the order book is only around 2.5% of the existing fleet. So SSY's base case, as I come towards the end of the presentation, shows there that we do expect lower new building deliveries in 2022, allowing for slippage, non-delivery. We don't anticipate a major increase in demolition, but that may start to change once decarbonisation measures take effect and start to bite. Then there is scope then for more demolition. And we're very conscious of the numbers of dry bulk carriers built in 2011 and 2012 that could well face interesting decisions by the time we get later on in the 2020s, when potentially tougher decarbonisation legislation can take effect. China's position is very interesting at the moment. The stated aim of a lot of Chinese policymakers is to control steel production, keep it very similar to 2020 levels. Our forecast then for the rest of the year is that quite a bit of slowdown this year in steel production. And we're also conscious that iron ore imports into China are already running significantly behind last year's very rapid pace. So for 2021, that certainly last year was really about China offsetting some of the decline in the rest of the world. This year's seen that increase in the rest of the world. The negative growth in 2020 owed a lot to quite severe declines in coal, and we're seeing those volumes increasing over the course of 2021 and into 2022. In conclusion then, we note, and we're taking the phrase here from the IMF, of a vaccine-powered economic and steel market recovery. Now that in itself really is quite a useful phrase, because it really does outline the fact that those countries that don't have vaccination programs, aren't fortunate enough to have large-scale vaccination programs, of course, are more at risk in 2022, and that also is in an economic sense of the word as well. We also highlight the impact, this temporary decontainerization we've seen benefiting dry bulk carrier vessels. And some of the more owners with more conservative technical teams beginning to turn towards making arrangements to take containers on board. The China slowdown is no longer a theory. We're actually seeing that taking effect. And of course, that would be one of the main risks to the outlook, negative risks to the outlook in 2022. Yes, there are certainly positives. Recovering Indian coal demand would be one of those, for example. But if there's anything that could unsettle this market, it could well be relating to a China slowdown. The COVID risks have been both positive and negative for dry bulk freight market balances and could continue to be so in 2022. And that role of fleet inefficiencies, whether it's quarantining, port congestion, changes in voyage length, that has been crucial in offsetting the negative impact on the dry bulk freight market from the ongoing expansion of the bulker fleet. And then finally, we do note that the ordering for new buildings at this stage of the freight market cycle has been restrained. So in conclusion, we can see there a lot of those factors having an impact, extraordinary year for shipping. And we can see many of those continuing to have an impact in 2022, if not supporting the market to the same degree, certainly having some kind of impact in next year. So thank you very much again for the invitation to speak, and I wish you all well, and hopefully looking forward to being able to speak to you in person in Korea one day soon. Thank you very much.
Thank you very much for that great presentation. Let's put our hands together for the speaker. So this presentation was about dry bulk market, the review and outlook. Thank you, Dr. Langston, for that great presentation. And if you have any question, please leave it on the chatting window, and we will get back to you via email later on.
네, 팬데믹 후 우리
So the theme of this year's conference is post-pandemic, the path to take. And the next presentation has the theme of analysis and prospect of tanker market. And we will invite Senior Marine Analytics of Oliver G. from Macquarie.
Thank you very much for joining me for the tanker session. In the next 30 minutes, we're going to mainly focus on the crude and fuel oil carriers, but we're also going to discover some of the new trading patterns for the refined product fleet for the next 5 years. A brief introduction about our company. McQuilling Partner is a global tanker brokerage firm. We have 10 offices around the world, headquartered in New York, but we also have an office in Singapore. In our Singapore office, we're focusing on brokerage service for the crude oil, refined product, as well as chemical tanker cargoes. For McQuilling Services, we provide our client consulting and advisory services. Something to note here is we are a separate revenue entity, which means our forecasts and our viewpoints are not going to be impacted by the tanker brokerage side. Before we go into the details, I definitely want to show our client this slide. This is a quick summary of what we think the VLCC or the DPP tanker are going to look like for the next 5 years. In the beginning of 2021, when we published the January Tanker Market Outlook, this kind of book, in here, we already guided our client that 2021, on the market fundamental basis, it does not really seem to be a very constructive year on earnings. And the first 10 months in 2021 already validated what we think here. So if you are a non-eco VLCC tankers, likely the average earning for the year are going to be below $0 per day. Of course, if you are eco tanker owner and if you have scrubber installed on board, then the earning is likely to be better. However, overall, we think that this is still below the operating cost. So 2021, we already know it is a very challenging year for the VLCC fleet. We think that the recovery phase is not likely to happen right now, but likely to be by the end of 2022. Here is a couple of reasons behind it. We do see that the demand is picking up. The spot market is definitely getting more and more active, but the pressure is from the supply side. Still, there are about 6 VLCCs to be delivered from the new building yards in the next 2 or 3 months. And in the meantime, we do think that there are about 13 VLCCs yet to be released from the floating storage. When those ships discharge their cargo, they are likely to go back to the trading fleet. And these 13 vessels are going to put a lot of pressure from the tanker supply side. In the meantime, there are about net of 3 to 5 VLCCs month over month to be released from the dry docking yards. The thing is, when the vessels are releasing from the dry docking yards, they're typically going to take a below market level rate for the first cargo. So this is also going to drag the earning and drag the freight levels down as well. The reason why we think the recovery is going to happen by the end of 2022 and likely continue in 2023 and eventually reaching the peak in 2024 are also both on the tanker demand and tanker supply side. On the tanker demand side, we definitely think that the recovery phase of the VLCC is going to happen. There's no doubt about that. Brazil is continue producing crude oil from the offshore facility, likely to be pushed to the Far East region. With for the US Gulf region, we're also going to see a slight increase of the shale oil production in 2022 onward. And those cargo, if they're going to India, to Southeast Asia, to Far East, these are all pretty good selling distance for the VLCC tankers. That will also translate into a healthy VLCC tanker demand. For Northern Europe, the Johan barrel are also likely to be pushed to the Far East region. That voyage is a very healthy and very constructive story for the VLCC fleet as well. So on the tanker demand side, we are very optimistic about the growth. On the tanker supply side, it is also supporting the story. So if we're looking at the new building market at the moment, the new building price for the VLCCs are at a very extraordinary level at the moment. It is mainly coming from 2 very important elements. First is about the raw materials. If you're looking at the steel price and if we're looking at the current coal price, in the market, these prices has increased significantly in the last 6 months, especially for the coal price. The coal price are being used in some of the country for the power generation plants. So those demand has pushed the coal price extremely high, and that will also support the overall VLCC newbuilding prices. Secondly, is about the yard capacity. Recently, because of the very healthy return of the gas market, because of the container market and also the dry market, we are seeing that there's a huge increase at very rapid inflow of vessel newbuilding orders for those vessel sectors. So it is taking away a lot of yard capacity around the globe for ordering or for the oil tankers. So that's why we think that VLCC newbuilding prices is likely to remain firm for the at least next 6 months. In that regard, if we're seeing a very a very high price on the newbuilding side, but if we're looking at a very low earning environment, that will trigger very limited tanker newbuilding orders. So a low newbuilding order in 2021 and likely to go to the first half of 2022 will result a low vessel delivering schedule for 2023 and 2024. So that is also another factor we think is going to support the VLCC tanker market. On the clean tanker sector, we are definitely much more constructive on earnings than the DPP market. In 2021 alone, if you see on this graph, all LR2, LR1, and MR2 earnings are above the level we see it before on the VLCC side. So the constructive picture of the CPP tanker fleet is coming from both tanker demand and tanker supply side. On the demand side, because of the new refining capacity built in the Middle East and also in the Far East region, we expect there will be an increasing amount of gas oil and diesel flow from those two regions to Northern Europe. At the same time, we think the west to east naphtha flow is also going to increase, which is bringing the naphtha cargo from Northern Europe, from Mediterranean, from US Gulf to Southeast Asia and Far East region. As you can see, it is a very long distance trade, and these trades are very typically going to fall in the LR2 tanker space. So that's why we think the LR tanker is going to benefit a lot from those developments. For MR2, yes, there are also going to be a lot of constructive stories. The increasing refining capacity in the Far East going to push a lot of cargoes, maybe also it's for gasoline and gas oil cargoes, to the west and east coast South America. That is a very typical MR trade. And due to the reduced refining capacity in Australia and New Zealand, there are also MR demand to be pushed higher from the Far East, maybe from the Southeast Asia as well, and going down to the Australia and New Zealand regions. That is on the tanker demand side. On the tanker supply side, it is also very constructive, especially for the LR1 tankers. So if you're going to ask me a question, which vessel sector you're going to invest your own money in, if you give this opportunity, I would definitely recommend LR1s. The reason is currently on the order book analysis, there are 0 LR1 orders. There are just none LR1 currently on the order book. It is with the increasing demand on the LR sector and also the supply side, if we are seeing gradual exit of LR1 tankers due to the aging of the fleet, we could see a very constructive picture for the LR1 sector. So that is why for 2021 and 2022, we think LR1's earnings are likely to even outpace what the earnings look like for LR2s. Now let's talk a little bit more about the market fundamentals. Firstly, let's talk a little bit about the crude balance. This graph shows us the global crude balances on the month-over-month basis. We know that in the very beginning of 2020, when Saudi and Russia having the price war, or instead, both nations are actually targeting the US shale oil producers, the market has been flooded with a lot of crude oil. Those oil are being put in the onshore and also the offshore floating storage unit, which takes significant amount of VLCC out of the trading fleet and being utilized to store crude oil. So that is the main reason why we are seeing significant increase in the VLCC earning that escalated to over $200,000 per day. So that is what we are seeing at that time. But after that, we have been experiencing about 12 to 15 months of cumulative destocking process. It is very painful process. The reason why the destocking is hurting the VLCC tanker market is that it not only released tonnages from the floating storage back to the trading fleet that were potentially pulling the freight down, but also the destocking is also taking away the transportational demand. So the previously one oil demand will translate into a crude oil tanker to carry cargo from one region to another, but now those cargo demand can be filled by the destocking of the inventory level. So that is double whammy that is hurting the tanker market by a lot. So that is why we have been seeing the VLCC tanker earnings to remain at a very, very low level for a very long period of time. But so overall, what we see here is a tanker on the crude oil side, a crude oil deficit is not unlikely to support a recovering phase of the VLCC tankers. Only when we're seeing a surplus of the global crude balance that could help the crude oil market more, because you are able to bring more and more ships from the load region to the discharge region and put them back into the storage. Some of the ships can also be used for a floating storage purpose. So overall, that is something we want to experience. And is it going to happen? Yes. In 2022, if you look at on the right-hand side of the graph, we are going to see a very constructive, again, crude oil surplus on the global basis. So in that regard, we are likely to see some really significant increase in the tanker earning environment, and these kind of support is going to be material as well. This slide shows us the crude oil demand and the oil product demand. It's a comparison of the two. Although the demand recovery phase look very similar on the pattern, but these two are not 100% the same. So if you look on the left-hand side, the crude oil demand, if we add 2021 and 2022 year-over-year increase, we will probably need to wait until the end of 2022 to recover all the loss that we see in 2020. But if we see on the right-hand side, on the oil product demand, we're likely to see in the middle of 2022, we should already compensate all the loss we see on the oil product demand in 2020. The reason why the oil product demand is going to recover at a higher speed than the crude oil demand is mainly due to LPG as well as biofuel. For the LPG and biofuels, these two products are not coming from the crude oil refining systems. So that is the major reason they're being counted on the right-hand side, but those increased demand are not coming from the left-hand side. So that is why we're seeing that kind of trend. Why this is important? Because the DPP tanker demand is highly correlated with crude oil demand, and the CPP tanker demand is highly correlated with oil product demand. It is again showing us that the CPP tanker fleet is likely to be more constructive than the DPP tanker fleet earning recovery picture going forward. So now let's take a look on the supply side. On the left-hand side, we're showing the crude oil supply growth year over year for different regions. In 2021, both OPEC countries and US shale producers have remained disciplined on their production level. But things could be different as we move into 2022. Middle East alone is going to increase their crude oil supply by about 2.7 million barrels per day. And US shale oil producer could increase their production by about 650,000 barrels per day on the crude oil supply side. However, if the US shale producer decided to increase much higher and much faster than that, then Middle East is likely to remind them again by pumping significant amount of crude to the market, lower prices again. If that happens, it's actually going to story for the oil tanker. It will not only pump the transportational oil demand, crude tanker demand, but also going to use VLCCs and other vessel sectors for the storage purpose as well. So that if that happens, if that kind of black swan event happens, it's actually going to benefit the VLCC owner by quite a lot. On the right hand side, we're showing here on the regional refinery capacity growth year over year. So the region we want to focus on is in the Middle East, which is colored in the light blue. In 2022 and 2023, these 2 years, the region is likely to bring about 1.2 million barrels of new capacities. These refineries are likely to use regional crude, so there's no doubt that's going to happen. And that because of that, it's likely to limit the export volume from the Middle East region. The second region I want to point out here is India, which is colored in this brown color. So India is adding a significant amount of new capacity in the region as well. These refineries could source a lot of crude from Middle East. So if we go back to the Middle East region, not only the total export volume could be limited because of the regional Middle East refinery capacity increase, but also a lot of those previously long-haul trades from the Middle East to the Far East, Middle East to the Southeast Asia trade could be reduced to Middle East to India. That is a very short-haul trade for the VLCC tanker sectors, and also could be some of the Suezmax demand as well. So overall, I think for the VLCC side, the increased capacity in India and Middle East is not looking good for this tanker sector. Another region I want to point out here is West Africa. For West Africa, the Dangote refinery could potentially bring about 650,000 barrel per day capacity from the region. But however, due to the limited investment on the infrastructure and oil wells in other countries like Angola and Nigeria, the crude oil production level is facing a lot of pressure on the future development. And because of this increased refining capacity, likely to source a lot of domestic regional crude, we think that the export potential from the West Africa could also face a lot of pressure. Going forward, West Africa to the east and also West Africa to UKC volume could see some very significant pressure going forward. It will also change the flow of the CPP tankers as well. So for West Africa, maybe in the future, there won't be a lot of our demand that will be needed from the UKC to West Africa. So those demand is likely to go away as well. So it's not only going to impact the DPP market, but it will also have impact on the CPP trade as well. Now let's take a look more about the tanker fundamental side. The DPP tanker demand for 2021 is likely to remain somehow flat than compared to the 2020 level, with more and more growth will likely to happen in the later years. So now let's focus more on a regional basis. From the Middle East, as we previously mentioned, because of the increased refining capacity, the increase of the VLCC trade flow from the Middle East to the East and from the Middle East to Southeast Asia are likely not to grow at a very fast speed. Somehow it will remain at a pretty steady level. However, due to the increased capacity in India, we expect a lot of volume will actually go to the India, which is a much shorter distance, a much shorter voyage as well. For the next region, for the East Coast South America, because of the continuing investment on the offshore, the floating production units, we expect this region will support the VLCC demands quite significantly moving forward. If we see from East Coast South America to the Far East region, for next year, we're expecting about 154 VLCC lifting for the whole year and potentially increase to 178 as we reach to 2025. and this is a very constructive flow for the VLCC and the overall dirty market as well. For the Mediterranean, we expect both Euro for the Russians, for the Libya barrel, for the CP barrel could find a home naturally in the Far East region. And this is mainly a Suezmax trade. So overall, for all the DPP tanker sectors, I would definitely favor the Suezmax vessel class. The reason is we expect to see a lot of the Middle East crude to be transported on Suezmax, going to Europe and going to Mediterranean region, and bring a backhaul cargo from Mediterranean to the Far East. And this will create a very good opportunity for triangulation to reduce the ballast lag and increase the Suezmax earning environment. For the Northern Europe region, mainly is Johan barrels. We expect that the increasing crude supply from that region will push a lot of the cargo on VLCCs to the Far East. So if we look at the red bar on the right-hand side, that volume is expected to increase to 108 in 2022 and further increase to 133 by 2025. On the smaller vessel sectors, on Aframaxes, we also think there will be a lot of volume to be pushed to the US Gulf refining system as well. Currently, a majority of those trade flows are fuel oil, which is under some pressure in 2021 because those fuel oils are being used for power generation because of the energy crunch. But if in the future we're seeing Johan barrel to be pushed to the US Gulf region, that could create nearly 100% utilization for this vessel sector, bringing the US crude to Europe and bringing back Johan barrels back to the US Gulf refining system as well. This is definitely going to be a very constructive support for the smaller tanker sectors. For the West Africa, as we previously mentioned, that region is going to remain some pressure. If we see on the bar charts, almost all the regions are projected to reduce their volume on VLCC and Suezmax's volume for the two different regions, especially to India and to Far East regions. For the US Gulf, 2021, we know that because of the reduction of the crude supply, we have seen majority of the region are experiencing some drop in the volume. But India is a standalone case. 2021, we see a lot of volume going to India, but that trend is unlikely to sustain because once Middle East are increasing their production, India is likely to go back and switch back to use Middle East crude instead of US Gulf crude, because that region and that countries is purely on the pricing perspective. When the supply side is going up from the Middle East, the price for Middle East crude to India is likely to go down. So that is something we see that US Gulf to India, that trade is now unlikely to sustain at the current level going into the next 4 years. So on the clean side, it's a very similar story. 2021, we are seeing some gradual increase higher than the DPP side, and the majority of the increase we could see is in 2022 and 2023. So here, we're going to focus more on the regional balance perspective. As we previously mentioned, Middle East and Far East, because of the increased refining capacity, we're seeing that both regions are going to have extended product balance for gas oil, for diesel, for jet. Naturally, those cargo will be exported from those two regions to the Northern Europe and maybe to further west. For the Middle East region, because they are switching their yield towards gasoline, we expect that Middle East naphtha balance could somehow remain steady, although their overall refining capacity has been increasing. In the meantime, Far East and Southeast Asia naphtha deficit will definitely be worsening. In that regard, we expect that west of Suez market is likely to step in and help to offset some of the deficit the Far East and Southeast Asia region are facing. Those are going to benefit the oil tankers to bring naphtha cargo from Mediterranean and going to the Far East and Southeast Asia. Some of the MR tonnage are also going to be deployed to bring the US Gulf cargo to the Mediterranean and then transfer into a larger tanker on a larger scale. Southeast Asia and Australia, this is a region we know that a lot of refineries are closing. So that the increased oil product demand facing the reduced capacity, that will trigger more and more oil product import, likely coming from the Middle East as well as the Far East region, which is naturally an R1 and MR2 tonnage demand. So for the clean sector in the east of Suez, we're definitely seeing a much more constructive picture overall. South America, for that region, we have not seen a lot of new refining capacity being added in these two regions. However, the demand has increased quite significantly. So what we think here is those cargo are likely coming from both US Gulf and also the Far East region. We understand the Far East side because the increase of the refining capacity, a lot of the gas, oil, diesel are likely to find a home in those two regions. But the US Gulf is something different. The US Gulf cargo previously sending a lot of the gas, oil, and diesel to Europe. However, because Middle East is stepping in using LR tonnage to bring those cargo to the European regions, US Gulf cargo probably not going to be that competitive in the European region compared to the Middle East cargo. So that's why a lot of the US Gulf cargo could also be sent to Brazil, to Peru, to Colombia, to those regions that naturally need the gas, oil, and diesel product. So a lot of analysts think that the Dangote refinery in West Africa, that is likely to be a negative story for the CPP market. However, we don't think that's the case. Although there will be a huge reduction of the LR demand from UKC to the West Africa region, we think that the excess product are likely to find home in the Far East and Southeast region, which is significantly longer distance. So for LR tonnage, it is actually a supportive story that is going to promote the LR tanker demand going forward. So now let's take a look at the tanker supply section. So this graph shows us the age profile for each of the vessel class in the DPP tanker fleet. So if we look at the VLCC, due to the limited new building orders, the current order book for VLCC only represents about 8.8% of the overall fleet. And at the same time, there's significant amount of demolition candidates in the market. If we add the vessels age 15 and up, is there about 20% of the fleet is actually above the age of 15. So those ships could potentially being removed and going to the scrapyard, and that will help to balance the VLCC tanker demand and supply equation. So on order book analysis, again here, we can see 2021, we really see a very low ordering period. VLCC will only capture 27 VLCC so far being ordered. That is a number significantly below the average. That could help the market to rebound very nicely in 2023 and 2024. So this is overall what we think the addition and deletion profile for the DPP sector. For 2022, we do project that there are about 42 VLCC to be demolished. I know this is a high number, but this is something we needed in order to see the market to rebound. So if that's the case, the DPP tanker fleet is likely to gradually drop on the net fleet growth basis and likely to reach to a negative fleet growth in 2024 and 2023 period. The reason we have not seen a lot of VLCC being sold for demolition is because those tonnage have already been changed hands in the second-hand market. So since the beginning of 2020, we have captured a total of 77 VLCC, old VLCC, which is over the age of 15, has changed hands to some unconventional owners. And using AIS data to track those activity, we captured about 40% of them are doing some unconventional trade, which include turning off their AIS transponder off, loading in Iraqi, but a very adjacent type of port, and also loading in Southeast Asia, which we believe that some of them could be Iranian and Venezuela crude oil. So if in the future we could see some relief of the Iranian sanction or Venezuela sanction, although maybe that will be on a later time period, we could see those demand for the Gulf ship to go away, likely to balance the overall trading fleet a little bit as well. So looking in the CPP tanker fleet side, it's definitely a very similar picture on the new building orders for the CPP side too, especially for the LR1 tankers. If we look from 2019, there hasn't been any LR1s being ordered in these 3 years. That will significantly help this sector to outperform the other CPP vessel class, LR2 and the MR2, when the demand for LR1 is rebounding, but the supply side has remained pretty flat. So that's why we're very constructive on the LR1, but overall the CPP tanker fleet is remaining very constructive on the earnings side. If we look at the net fleet growth for the traditional oil product carriers, we already see a negative fleet growth since 2021 on forward. And for the chemical tanker fleet, also the curve is dropping as well and expect to remain flat going in the end of our forecasting period. So that's why we think that the clean market is likely to outperform the dirty market in 2021-2022 period, but eventually it will merge very closely on the earning perspective. So overall, that is something we see and we expect that the market will develop for the next 5 years. So that's all for my presentation. Thank you very much for your attention, and please feel free to let me know if you have any questions. Thank you.
네, 마무리하도록 하겠습니다.
Okay, this is the end of the presentation. It was the presentation delivered by Mr. Oliver G. Here we are at 2021 KOBC Maritime Conference.
So with experts around the world, we have discussed the current status and the outlook of the shipping industry. And now we are streaming online on YouTube and we have a lot of questions. So we are going to invite one person to entertain around 3 questions. Let us welcome General Manager Jung Young-do of KOBC once again to the stage with a big round of applause. So during our first session through online, a lot of participants have uploaded questions. We have around 3 of them. And now we are going to entertain them.
첫 번째
Do we have a Mr. Lee Hyung-seok? He asked the first question. The Capesize charter rate dropped from $80,000 to $30,000, so it was a steep decrease. And what were the major reasons behind it? In dry bulk, the charter rate is going up and going down drastically. There are 3 reasons. The Capesize charter rate goes up too fast. So it was more of the fundamental factor. So it included bubble. So it showed a steep rise based on bubble. That is why it was adjusted drastically. And since October, the congestion in Chinese ports is improving fast. According to our data, congestion level was 230 vessels in September, and in October it was about 180 vessels. So now it is a much better situation at the port. And steel production decrease led to less import of steel. And third factor is a tapering and other factors in the financial market. There is less liquidity, and the drop is even bigger with a focus on the leading market. So we have these 3 factors at the same time. That's why there was a steep decrease in charter rate. But in the short term, there are many negative factors in the Capesize charter market. So the rate could further drop. And there is a low new building order for Cape. That is why in the long term, there would be more positive factors coming up in the market. So thank you for the positive answer. And the second and third questions came from YouTube, and this is a question from We Grew In. So you said that new building order for container ship was 470. So isn't that oversupply? In the post-COVID era, is this the proper level, or this is the overheated level? So let me make a comparison with the past. When there was a huge order for container ship, it was around 2015. The market was not good, but the new order was about 2 million TEU. But the normal level was 500,000 TEU, so it was 4 times bigger. And in 2016, container ship market was at the lowest point, and there was the bankruptcy of Hanjin in Korea, and this trend continued until 2019. And before COVID-19, this impact was regarded as the long-term slowdown of the market, and I believe that the implications will stay if there are COVID-19. However, in 2021, there was a slight change. We had EEXI, which will be reinforced in 2023. There will be 2 changes, and there will be slow steaming. So there will be a lower number of vessels, and second, vessels which do not comply with the criteria will be demolished, and there will be a lower supply of ships in the future, so it can offset the current problems. And one more thing, in 2012 and in 2013, when we make a comparison with now, the container ship market is structurally different. So there is a smaller number of container ship companies, Maersk, and top 5 companies account for 65% of the entire market. So about the freight rate decrease, the shipping companies have much power in the market, so they can prevent the steep decrease of freight rate. So the situation is similar but somewhat different. So the freight rate will not decrease drastically. However, we cannot predict the exact level of prevention. So it might be a similar question. You talked about the scope of a forecast, and this is a question from AEROK. And regarding the forecast of shipping prices and falling freight rates in the container market, when will the turning point be, in the first half of next year or the second half of next year? So this is the question from YouTube channel. So let me answer in Korean. So the container market, I believe that it has already passed the turning point. So it was going up, but now it is flat. So because it is setting the new direction, and in November and in December, there will be changes until the end of this year. And it is very critical point. And in the first half or second half of next year will be dependent on the last 2 months of this year. And in the long term, next year, the cargo volume in the container ship will decrease next year. In the US, cargo volume increased to 14%. However, next year, there will be no increase. It will be only 1% increase. So next year, the market will find a balance. And lastly, in the second session, we will listen to the prospect of container ship market. So you can find more clear answer in the second session. So the person who asked the question is Erok, so I will answer in English briefly.
Mentioned before, I think the turning point of container market is already coming, and Secondly, I think the market balance of demand and supply of the container market will be balanced because the growth rate of the demand of the container trade will be reduced dramatically from this year to the next year. And finally, I recommend the next session, we prepared the container market forecast and the ship price market analysis and forecast. Both two guys, Mr. Alan Murphy of the Sea Intelligence and David Jordan of the MSI, they are better than me. Thank you for your question.
네, 마무리하겠습니다. 부장님 오늘 질의
Thank you so much for that great answer, Mr. Jung. Let's give Mr. Jung a big round of applause. With this, we have completed the Q&A session. And he also was able to answer the questions in both Korean and English. Thank you very much. So we also have the second session waiting up, so I ask for your patience until the very end. We had more questions, but in the interest of time, we have entertained only 3 of them. I apologize. We will now officially close the first session and have a break. We are going to resume at 3:30. We have a lot of great presentations for session 2, so please stay with us.
웨비나 페이지에 출석 체크 아직 안 하셨다면 출석 체크 부탁드리겠고요. 만족도 조사는 우리 행사가 모두 끝난 후에 저희 한번 부탁을 드려보도록 하겠습니다. 선착순 100분께 샌드위치와 음료 교환권, 그리고 또 선착순 100분께 저희 파인트 아이스크림 교환권까지 중복으로 드리고 있으니까 컨퍼런스 시청하고 계신 분들은 많은 참여 부탁드리겠습니다. 3시 30분에 뵙겠습니다. 고맙습니다. 네, 온라인과 오프라인으로 함께하고 계신 분들께 2부 세션
So before starting the second session, we have an announcement for online and offline participants. We have only 3 minutes away from the time we will resume the session. So please take a seat. And if you are an online participant, please stay tuned for the session.
온라인 이벤터스로 참여하고 계신 참가자분들 이벤터스 웨비나 페이지에 출석 체크 아직 안 하셨다면 출석 체크 진행해 주시면 저희가 샌드위치와 음료 쿠폰 따뜻하게 드실 수 있도록 보내드리고요. 그리고 만족도 조사는 지금 하지 마시고요. 저희가 행사가 다 끝나고 나면 모든 세션 시청하신 후에 저희가 고언을 청하겠습니다. 그때 6시 30분까지 저희가 설문조사 창은 열어놓으니까요. 선착순 100분께 또 역시 파인트 아이스크림 교환권 드립니다. 출석 체크와 그리고 설문조사의 선물은 중복으로 모두 가져가실 수가 있으니까 여러분께서는 저희가 좀 더 나은 좀 더 발전적인 컨퍼런스를 개최하기 위한 고언을 꼭 부탁드리겠습니다. 중복 참여 가능하니까 그냥 나가지 마시고 꼭 클릭해 주시기 바랍니다. 자, 그리고 국내 참가자분들께서도 이벤터스의 유튜브 라이브 중계 메뉴 클릭하시면 영어 통역이 지원되고 있습니다. 유튜브 채널은 영어 통역, 그리고 이벤터스 영상은 한국어로 함께 하실 수가 있으니까 용이한 방법으로 오셔서 여러분 정보 많이 얻어 가셨으면 좋겠습니다. 자, 지금 시각 3시 29분 지나가고 있습니다. 많은 내빈분들 자리 착석하시면 여러분 기다리셨던 2부 세션 진행할 예정입니다. 2부 세션도 알찬 주제 많이 마련해 뒀습니다. 여러분 잠시만 기다려 주십시오. 3시 30분에 2부 시작하겠습니다. 네, 많이
Thank you for waiting. So it's 3:30. So thank you for your participation online and offline. We will now begin with session 2 of the 2021 KOBC Maritime Conference. This is the 4th round of the conference and hosted by the Korea Ocean Business Corporation. We are discussing the current status and outlook of the shipping industry. And under the theme Post-Pandemic, the Path to Take, we are going to think about the past, present, and future of this industry. We had successful discussions in session 1, and we are about to begin with session 2. On Eventers, you can listen to Korean interpretation, and on YouTube, English interpretation. So if you are here on the venue, please check your receivers to set to the language of your choice. In session 2, we are going to listen to presentations on the present and future of the container ship market and an analysis on the container logistics supply chain and also the market trend regarding new builds and second-hand markets. Let me introduce the first presenter, who is Mr. Alan Murphy of Sea Intelligence. He will give a presentation on analysis and prospect of container ship market.
Good afternoon, ladies and gentlemen. My name is Alan Murphy. I'm the CEO and founder of Sea Intelligence. We are a dedicated container shipping research firm. My presentation today will be on the impact that coronavirus has had on the container shipping markets and what we can expect going forward. I would first and foremost like to thank the organizers at KOBC for inviting me to speak to you here today. Now, in my slides, there are a little bit more information for those who are not familiar with Sea Intelligence and the work we do, but I won't waste your time now and rather go straight to the presentation. The absolute key message to get across today is that 2020 and 2021 has absolutely no precedence in container shipping. The developments that we have seen over the past almost 2 years are absolutely unprecedented, which also makes it difficult to say anything about where we move into because it's very hard, if not impossible, to compare the current developments with what we've seen in the past. There are some region abbreviations that I will be using throughout the presentation. They are listed down here, but they should be hopefully self-explanatory. So the first thing that of course has gotten an incredible amount of attention is the absolutely insane developments we have seen in freight rates. Now, I have listed here the main spot rates out of Asia. So the 4 trades to Asia North Europe, Asia Mediterranean, and also to Asia US West Coast and Asia US East Coast. And we can see that at least going back to 2018, and this is data from Senita, we can see that freight rates, spot rates on 40-foot containers have been somewhere around $1,000 per 40-foot to the US West Coast and around $2,000, $1,500 to $2,000 per 40-foot to the US East Coast, a little bit higher at some points, and around $1,500 to $2,000 per 40-foot to on Asia Europe. And what we see is there wasn't really an impact when coronavirus first hit in the beginning of 2020. We didn't see a massive impact on freight rates. They actually remained fairly stable. But as we came into the second half of 2020, from August and forward, first we started to see that the Trans-Pacific freight rates started to basically double up till around $4,000 per 40-foot. But an even sharper increase happened around December 2020 when the Asia-Europe rates started to increase quite considerably. First, they up till around $8,000 per 40-foot. Then they remained there roughly till about April, May in 2020. And since then, they have increased even further. So that pure ocean spot rates right now are somewhere around $13,000 to $14,000 per 40-foot. That is, of course, completely unprecedented and what has drawn considerable headlines. Now, on Trans-Pacific, the freight rates are now roughly, on spot market, they're roughly around $8,000 to the West Coast and about $10,000 per 40-foot to the East Coast. Now, it's important to understand that these figures here, as recorded by Senita, are the pure ocean rates. They don't take into account the very considerable surcharges that the shipping lines have introduced over the last couple of years in order to secure equipment, I would say to get an empty container, or to secure space on a vessel. Now, those surcharges are not part of the ocean rate. That's why they're not captured by index providers such as freight rate providers such as Senita. So in addition to this, there's the surcharge. Now, what are those surcharges? Now, that's not clear. There's not visibility on it. They range from the very low end of $500, which very few would be experienced, all the way up to at least $10,500, according to estimates made by Senita. So not only are these base ocean spot rates incredibly high, they would be even higher when you consider the quite substantial surcharges that have been levied. But since we can't capture them, we only have the pure spot rates here. But with that said, it's clear that it's absolutely unprecedented. Absolutely insane levels that the freight rates have gone to in the spot market. Now, what doesn't capture quite as much attention is the development that we've seen in the contract market. So large cargo owners, large shippers will usually have long-term contracts with the shipping lines and will not trade the majority of their cargo in the spot market. But also the contract market has seen considerable increases. Now, the contract market on Asia-Europe, usually around $1,500, has in recent months climbed all the way up to $4,000 or $5,000 for 40 foot. Whilst it's not been quite as wild in Trans-Pacific, going on the west coast from around $1,000 to up to about $2,500 in a contract market, and to the east coast from around $1,500, around $2,000 up to about $3,300. Now, those are quite substantial increases also in the contract market. Not as wild as the spot market, but the spot market is what is usually mentioned, not only because of the incredible increases that we've seen, but because most index providers can only capture the spot market. That's why we like CEMETA, because they also provide a perspective of the actual contract market, which still is the majority of the cargo is being moved on contracts. Now, unfortunately, this is not the full picture, and that's another thing that we can see from CEMETA, because these are all of the contracts, both those that have been recently signed, but also those that have been signed maybe a year ago. Now, CEMETA also provides an index of contract rates that have been signed just within the last 3 months. And what we see is that we've actually seen quite considerable increases. So recently signed contracts have been closed much higher than they have been in the past. Now, this gives an idea of the momentum that we're seeing in the contract market, which suggests that contracts are the average contract rates are probably going to increase considerably. We see that contracts on Asia-US East Coast and Asia-North Europe have been signed in the range of $8,000 to $10,000 in the past few weeks, which is, again, if you're used to a market where contracts are $1,000 to $1,500, maybe $2,000 to the US East Coast, this absolutely blows a hole in your budgets and leaves you with a situation where for some shippers, for some cargo owners, they're simply not capable of actually turning a profit, and some cargo simply can't ship at these rates because they simply can't eat those costs. Outside of the wild developments we've seen in the freight rates, we also see that the amount of capacity that the carriers have deployed on the major trade lanes, so Asia, North America, West Coast, in the top left corner here, absolutely unprecedented level. So the carriers have been criticized for not providing enough capacity to meet demand. But as can be seen from the figures, the carriers have basically any vessels that can float are deployed. So for 2021, we see on 3 out of 4 major trades, we see absolutely unprecedented levels of supply. Now, this is the actual deployed capacity even after blank sailings are taken into account. So while there has been substantial amounts of blank sailings, which I'll touch upon next, the actual deployed capacity from the carriers has been incredibly high, and as we also saw, even in Asia Mediterranean, what is currently scheduled for the fourth quarter, even though there's still 2 months left of the fourth quarter, in 2021 is far and above anything that we've seen before. So the carriers have basically put anything that can float onto the ocean. And that's even considering that the amount of sailings that have been blanked are absolutely unprecedented. Now, what I've done here is for each quarter since the first quarter of 2012, is since when Sea Intelligence started recording the number of blank sailings, we've recorded the number of blank sailings on Asia-Europe and the combined Asia-Europe trade and the combined Trans-Pacific trade. And what we can see is that there's quite some seasonality, of course, in the number of sailings that have been blanked. Usually when we hit the first quarter in Chinese New Year, it's when we see those quite considerable increases. But what we've seen since basically the onset of the coronavirus pandemic, the amount of capacity that has been pulled, that has been blanked, where sailings have been cancelled, is absolutely, again, I sorry to say the word unprecedented so many times, but it is incomparable to any period in the past. Now, there was, though, in the third quarter of 2020, a significant drop in the amount of capacity that was called. That was because when the pandemic first hit in the first and second quarters of 2020, massive amounts of demand were curtailed. Lots of orders were cancelled, and the carriers had to blank a lot of sailings in order to keep their utilization levels at a sustainable level. They also had a lot of sailings scheduled to be cancelled in the third quarter. But as volumes came back, and that's something I will return to in a later slide, they actually managed to unblank a lot of sailings. Now, it could be questioned, why on earth, when we have an absolutely crazy demand boom on seemingly, why are the carriers still blanking unprecedented amount of sailings? Well, that's because in the past, when shipping lines were canceling or blanking sailings, they were doing so to manage supply down to a level that matches demand. That's not the case in 2021. All of these sailings that have been cancelled, they've been cancelled because the vessels simply could not make it back out to Asia in time for their scheduled sailing, so they had to be cancelled. So the period here in 2021 is also incomparable to the past, not only because of the amount of capacity that's been blanked, but because the driver of this blank capacity is not to balance capacity, not to curtail capacity, but simply because of the congestion preventing the shipping lines from bringing the vessels back out to Asia in time. Meanwhile, on service levels, we look at schedule reliability. It is clear that current schedule reliability since the second half of 2020 has been absolutely abysmal. We show here the global level, which started to drop quite considerably. Well, there has been volatility in the past. Global schedule reliability has always been roughly around 70 to 80%. So 70 to 80% of vessels would arrive on time. But this has started to tumble in July of 2020 and just continually dropped until we hit basically a new plateau in December 2020 with vessels being on time. Roughly about only a third of vessel arrivals are on time from a global perspective. On Asia and North Europe, it's even worse at around 20 to 25%. And Trans-Pacific has been swinging around 10 to 20% reliability, which is absolutely unprecedented. The only comparable point in time we have was during 2015 when we had a labor dispute in the US West Coast ports, where Asia, North America, West Coast schedule reliability dropped down to about 20 to 12%. But that was for 1 month. We've now been dealing with these absolutely abysmal schedule reliability figures for almost a year. So, and on top of that, the vessel delays. Vessel delays on average globally on Asia, Europe, have been roughly around 1 day. So on average, a vessel has been about 1 day late, which in itself is not very impressive. Slightly worse on Trans-Pacific, but as I always see from July 2020 and onwards, the vessel delays have absolutely exploded to the point now that vessels on average delayed 10 days when coming into Asia, North America, West Coast on the Trans-Pacific. It's not quite as bad on a global perspective, but we still have globally on Asia, North Europe, vessels are on average 5 days late. So right now, cargo owners are living through a rather horrendous situation where freight rates are absolutely through the roof, 3, 4, 5 times, maybe even 10 times what they're used to when you're also considering the quite substantial surcharges that are being levied on them. The amount of blank sailings that they experience, so cancellations of sailings, is absolutely unprecedented. And those vessels that actually manage to sail are now almost, on Trans-Pacific, 90% of them don't arrive on time, and they arrive 10 days late on Trans-Pacific and 5 days late on a global perspective. So you basically get the worst product ever at the highest price ever. Now, what is then the driver of this? Now, a very central point to get across is there is no global demand. this is often a bit confused by some industry followers because on the left-hand side we have the actual global TU volumes being moved, and on the right-hand side we have the growth in TU volumes, global TU volumes. And if you just look at the year-on-year growth, it looks like we had an absolutely crazy demand boom lasting into the first half of 2020. But that's not true. The reason why we see this seeming boom when we do year-on-year comparison is that we're comparing against the massive drop in volumes in the first half of 2020. We believe a much better measure than using year-on-year demand is to use the two-year demand. So we're comparing in 2020 against what happened in 2018 and 2021 against what is happening in 2019. And if we do that, so not comparing to the crazy year of 2020, but basically to the last normal year, we see that global demand has actually been very manageable, around 2 to 3% for most of the past year. So we're not experiencing a global demand boom. So what is then the driver of the market situation? If it's not because demand is completely out of a historical precedent, and what is then driving the current market situation? And the problem is that from a global perspective, demand is relatively modest. Demand growth is relatively modest, but it's not uniform. What we have done here is we've taken the 7 main import regions as recorded by Container Trade Statistics, and the red dotted line shows the market share of each of those regions. So Asia is by far the largest region, accounting for almost 40% of global imports, Europe around 20%, and North America around 18%, and so forth down the line. Now that's the market share listed by the red line. The bars here show the monthly 2-year annualized demand growth or volume growth. And what we see is that while Asia is the largest region, growth has been quite modest at roughly 2 to 3% for most months. The same thing with Europe imports. Even though it's a relatively large region, demand growth has only been less than 5% in all months, roughly 2.5% on average over the last year. The real driver of this demand growth is North America. So North America has seen 2-year annualized growth rates ranging between 5 and 10% in most months, which is far over the precedent, and in a single month all the way up to 16% growth. And that is really the driver. So it's the largest region that's seen considerable growth. Other regions like Latin America and Oceania and Africa have also seen somewhat considerable growth, but since their market shares are so low, it doesn't impact the global demand for space and equipment. To look at it slightly differently, we've also looked at what we've done here is we've compared each of the months since January 2020 in each individual month compared to that same month in 2019, how much volume was lost globally. And that's basically, you can see that almost 2 million TUs were lost in April 2020. And you can see what regions have been driving that. We see European imports lost a lot. We see that North American, Indian subcontinent. Now, if we look since the market recovered in second half 2020, of all the contribution, all the gain, TU gain, it is absolutely dominated by North America. So North America is the absolutely dominant driver of global demand. So while global demand itself is not that strong, North America demand is very strong, and that is the spark that has lit the fuse of the current calamities that we have in the industry. To put it a little bit in perspective, recent statistics have shown that right now year-on-year demand is almost 0%, but that's only because we're comparing to this extremely elevated level that we saw in the second half. Again, we strongly advise not to look at year-on-year growth rates, but instead look at 2-year annualized growth, so that we bypass the very volatile year of 2020. And what we see is an absolutely incredibly strong demand growth going into North America. And that is what sparked the problems that we're currently experiencing. And the underlying driver behind this incredibly high demand into North America is a shift in consumer spending. Now, this is the past 18 years of US consumer spending. And basically, this is the growth rates on spending on services, which is the blue line, on non-durable goods, with the red line, and durable goods, which is the green line. Now, it should be said that Americans spend quite a significant share of their personal consumption on services, roughly around 65%. But what happened is that while durable goods have grown at a rate around 5% annualized over 2 years for basically the better half of the past decade, after the initial shock of the pandemic in April and May 2020, what happened is that consumers, due to lockdown restrictions across the US, they basically shifted a large share of their consumption. So they went from about 65% of their personal income to be spent on services to around 55 to 60%. And they shifted that spending over onto durable goods. And we see this massive growth in durable goods consumption in the US, which has been the underlying driver of US container demand. Now, that was the demand side, but the much larger impact has then been the impact that has been on the supply side. Now, because of this relatively high demand going into North America, the hinterlands in the US, the ports, the hinterland, terminals, the rail yards, distribution centers have simply met capacity. And that has led to considerable congestion. Now, my friend and colleague Lars Jensen will be speaking a little bit more about the congestion that we've seen in North America. But we've been analyzing how much of the deployed capacity is actually being used, how much of it is being lost. And because of these incredible high levels of congestion in North America, we've seen that the share of capacity that simply gets stuck in congestion and does not actually help move containers has increased from around from a very low level in the beginning of 2020 to the point that in recent weeks almost 30% of all of the capacity deployed on the Trans-Pacific to the West Coast is being lost. It's simply just stuck in congestion. It's not quite as bad on the East Coast, but considerably amounts of capacity, of vessel capacity, is simply stuck in congestion and is not helping to move containers. And we've also analyzed this on a global level, and we're basically now at a level where historically around 2 to 3% of vessel capacity was lost to vessel delays and congestion. But this has grown quite exponentially since the second half of 2020, to the point that in the past 6 months, 10 to 12% of global capacity is simply lost due to congestion. Now, that means that when we're looking at, for example, North American demand, we're not only seeing that demand is growing 5 to 10%, but because of the congestion this additional demand has created, the vessels are getting stuck outside of port. Right now, we're seeing close to 80 vessels stuck outside of Los Angeles and Long Beach. Because those vessels are not moving and are stuck for several weeks, that capacity is not being put to use and it's actually being lost. And that loss is equivalent on a global level to a 12% demand growth. Because losing 12% of capacity has the same effect as if demand grew 12%. And that's why we've basically run out of vessels in the industry. On top of that, because of all this congestion and the inability to get the vessels back in time, we have also seen that the number of sailings were more than just one vessel per service. Normally, a service is a weekly service and one vessel sails per service. We now see that the share of services that have more than one sailing per week has increased to levels of 15, 20, and almost up to 25%. So not only is there an increase in demand, a massive loss of supply, we're also seeing that the vessels are getting bunched up, which in itself adds to the challenges of clearing these vessels. Now, all of those disastrous elements that cargo owners have been impacted has, of course, had an incredible negative impact on the cargo owners and shippers and importers and on exporters. But there's one party that have actually done quite well over the past year, and that's, of course, the shipping lines. Now, it's very important to understand the shipping lines did not create this crisis. They are, so to speak, not to blame for why it happened. The underlying driver of this is the pandemic. The pandemic has shifted consumption away from services and onto to durable goods, especially in North America. And this growth in demand has just simply knocked down the system to the point that we're simply not able to handle the volume. Now, the shipping lines, on the other hand, have taken the best of this very horrible situation. Now, first on a very high level, the average freight rates, now this is for the second quarter of 2021. Actually, these are all the second quarter freight rates going back to 2010 for those shipping lines that have published it. So the first thing, of course, to take away is that freight rates, global average freight rates charged by the shipping lines have all exploded in the second quarter of 2021 compared to the second quarters of the past 10 years. Now, it's important here to stress that this is the average global freight rate. And of course, this is on average what the shipping lines are making of revenue per TEU they move. Now, this is considerably less, of course, than the spot rates that we saw earlier in the presentation, but this is the average revenue that they make. It's also important to take into consideration, this doesn't mean that Costco is much cheaper than, say, for example, CMA, CGM. This is more a reflection of the fact that some of these shipping lines have a much greater emphasis on, for example, intra-Asia, where the trade is shorter and freight rates are lower. But the interesting aspect here is, of course, to see that all of the shipping lines have seen absolutely an explosion in freight rates in the second quarter. And that is very likely to continue into the third quarter. Again, the third quarter data not being out right now, but if we look at the increases in revenues that the shipping lines experienced year on year in 2021 versus 2020, we can see that they've increased basically from the lowest being Hapag-Lloyd, saw the revenues increased 63% over the second quarter in 2020, all the way up to Wanhai and Sim, who've seen 200% increase, so a doubling of the revenue in second quarter 2021 versus second quarter 2020. So an absolutely massive increase in the revenues. And on top of that, considerable growth in operating profit. Now, we've listed here the earnings before interest and tax, or operating profit for each of the shipping lines. And it's clear how it's absolutely exploded. All of the shipping lines have seen that the second quarter earnings before interest and tax in 2021 has been greater than the sum of the past 10 second quarters. So we can see some of them have increased their earnings before interest 5, 6, 7, 10-fold over 2020, which in itself wasn't a bad second quarter. So an absolutely massive explosion in earnings. Now, and a different way to look at that we've also looked at the earnings before interest and tax per TEU. And what we see is that the shipping lines used to make, varying from shipping line to shipping line, but somewhere around $50 to $100 in EBIT per TEU they've moved. This has absolutely exploded to the point that the major shipping lines have been making about $600 to $800 EBIT per TEU, and all the way up to Hyundai and Sim, which saw their EBIT per TEU explode up to $1,200 per TEU. So absolutely the best year ever recorded for the shipping lines. And that leads us into what's going to be, of course, a challenge going forward. At some point, this will turn. And at some point, relationships have to be rebuilt again. It's hard to say how long time will turn. We have some indications that this will probably be an elevated market going out at least to the end of 2022. New vessels will start to come into 2023 that might start to loosen it up, but not until we see basically a shifting of especially US consumption away from durable goods back into services is this gonna start to ease up. And there's no indication that that is happening anytime soon. If you do have any questions to this presentation, please do not hesitate to contact us at info@tintelligence.com or reach out to us on LinkedIn or any of the other places that we are available. Thank you very much for your time.
A big hand, please. So that was the first presentation of session 2. Thank you, Mr. Alan Murphy, for your analysis on the container market.
님께서도 말씀.
As Mr. Zhang mentioned in the previous session, we have many questions about the container ship market, so we have to explore solutions in the session. And let me introduce the second speaker. The title of the presentation is Analysis and Prospects of Container Logistics Supply Chain. And the speaker is Mr. Lars Jensen, CEO of KOBC Maritime.
Good afternoon, and thank you for inviting me to address you here today. What I'm going to take a look at is what is going on in the logistics supply chain and what is going to happen going forward. What will the new type of normality look like? And as you might already guess from my choice of a cover picture here, we are not necessarily at the end of the problems. We might not even be at the peak of the problems yet. Now, in order to look at that, the first thing we have to realize is the gridlock in the supply chain is caused by a large number of different elements, all coming together at the same point in time. Metaphorically speaking, you get a situation like you see in the picture here, where every time you try to solve one problem, you're simply creating another problem at the same time. This is going to be a very lengthy process to unravel the gridlock in the supply chain. As I said, there are many different factors, but one of the most important ones that are impacting the industry right now is the delays. And the delays have a number of ramifications. One of the most important ramifications, if we look on the ocean side, is shortage of capacity. It's not because there's a shortage of vessels. Realistically, we have enough vessels in the world. The problem is the vessels are tied up in queues outside ports around the world. If we look at some of the latest data from September, it's only 34% of all vessels that are actually on time. So 2 out of 3 vessels are delayed, and on average when they are delayed, they are more than 7 days late. And obviously, when a vessel sits still for a week, that's a week where it cannot move cargo. And it's therefore possible to calculate how much global capacity is effectively removed. Right now, it's about 12% of all global capacity that is removed from the market because of all these delays. And to put that into context, this in terms of scale would be the same as if either CMA, CGM or COSCO, the world's 3rd and 4th largest carriers, if either one of those were to disappear from the market overnight. This is a very significant problem. This is why there's simply not enough vessel capacity to move the cargo. It's not the number of vessels, it's the delays that is the problem. And this is what's impacting the supply chain. When there's not enough capacity to meet demand, the only thing that will then happen is freight rates will go up until you reach a point where sufficiently many customers decide now it is simply too expensive to move the goods and the goods will not be moved. You can see this basically in all the different freight rate indexes. This one I show here is the one called World Container Index, but there are many different rate indices out there. They all show exactly the same thing. Freight rates are now in many trades at historically high levels. For some of the major trades, we have not seen anything like this ever in the entire history of container shipping. Whilst in the last few weeks, there seems to have been reached a plateau on some of these freight rates. Some of them have declined slightly, but that is not a guarantee that we have now seen the peak of the market. Remember, again, these high rates are driven by the fact that there is just not enough capacity to meet demand. If the delays, the bottlenecks, the congestion in the ports gets worse, then potentially capacity could become further reduced, If that happens, you might see some of these indices go up even higher than what we have seen in recent months. And unfortunately, it does appear that the problems keep on coming. If we look, for example, at the US West Coast, it is clearly getting worse. It is not because the US West Coast is the only point in the world where the problem exists. It exists virtually everywhere in the world. It's just a lot more visible outside the Californian coast. In the beginning of 2021, we saw queues of up to 40 vessels sitting outside California. At that point in time, and that's only 10 months ago, that was seen as a major disaster. It was slowly getting better as we got into the early parts of summer, but then peak season came along with a lot more demand. Many carriers decided to start additional trans-Pacific services to meet that demand. But all of those services then come into the congestion and the bottlenecks, in this case in Los Angeles and Long Beach. And as of last week, we are now approaching 80 vessels sitting idle outside the California coastline. This means basically 500,000 TEU of containers with cargo sitting off the coast, not being able to be offloaded. This, as I mentioned, has been getting worse over the last 2 weeks. It is not getting better. If we look slightly into the future, there are especially two large risk factors that could make this situation even worse. The largest risk factor here relates to China, and it relates to COVID. The Chinese approach to COVID is very simple. If there are just very, very few cases of COVID, there will be a shutdown in the area affected, irrespective of what the ramifications are. If we look just at 2021, this is what led to a month-long shutdown of the terminals in Yantian. This is what led to a 3-week shutdown of a major terminal in Ningbo. It has incidentally also led to the shutdown of air cargo operations out of Shanghai Airport, which is the world's largest hub for air freight. So it's very clear the Chinese approach is contain and prevent the spread of COVID, irrespective of other ramifications. This, of course, also means that in the coming months, we are ever only 1 or 2 sick port workers away from an even larger problem with new large ports in China potentially being shut down. Or even if the ports are not being shut down, if this impacts the intermodal transport system, the impact could be just as devastating. We can hope that this will not be the case. I would sincerely hope that does not happen. But if we are realistic, there is actually a significant risk that we might see further port closures, and that will mean the impact on the supply chain could actually get worse than what we see today. As we look into the first half of 2022, there's another element we need to keep in mind. There is the end of the current contract between the Port Workers Union and the ports and terminals on the US West Coast. This contract expires by the end of June 2022 and therefore needs renegotiation. If we look over the last 20 years, this negotiation tends to usually go one of two ways. Either after a lot of noise, there is a solution and there is no impact. We can hope that will be the case. But we also have a couple of examples where this did not lead to a resolution, it led to the opposite. There were challenges in getting an agreement in 2015. This meant that at the beginning of 2015, we actually had congestion and bottleneck problems off the US West Coast that were as large as the ones we see today. If we look back to 2002, failure to reach an agreement actually led to a 10-day full closing of all container terminals on the US West Coast. So the risk for spring 2022 is that we will see slowdown or shutdown of some of the terminals in the US, but we can hope that there is an amicable solution. Right now, nobody knows which of these two will manifest itself. But that brings me on to another issue, because seen from the sky, like when we look at these ones where every yellow dot is a vessel just sitting at anchor waiting to be coming into port, it is easy to point the fingers at, let's say, the ports and say, well, the ports need to do something. However, the port is not necessarily where the problem truly resides. The problem for a port is if nobody comes to pick up the containers, the port gets full and then they will not be able to pull in more vessels. Already now, some of the terminals in Los Angeles and Long Beach, they are physically able of handling more vessels than they do. But the problem is, if they pull more vessels in, they have nowhere to put the containers. A concept you usually measure here is what is called dwell time. Dwell time is basically the amount of time a container sits in a terminal from when it's offloaded until the importer picks it up and takes it out of the terminal. Under normal circumstances, 3 to 5% of cargo stands there for more than 5 days. Right now, it's about 30%, so 1 in 3 containers sit there for far more than 5 days. This is why the terminals are congested. So until this process is sped up, that importers are picking up their containers, we cannot solve the congestion in the terminals. If we cannot solve the congestion in the terminals, we cannot solve the shortage of capacity for the vessels. So if we start to look inland, why is this so hard to solve? Well, part of the key problem in why this is hard to solve is many moving components. In order for an importer to pick up the cargo, the importer needs to get a truck, and there's a shortage of trucks. They need a driver, they are also in short supply. Then they need a chassis. In the US, it's uniquely difficult because the chassis and the trucks are not the same and are owned by different companies. There's a massive shortage of chassis. If they finally manage to pick up the container, the warehouse might be full, which leads some importers to leave the container on the chassis rather than returning the chassis, now making the chassis shortage even worse. There's also not enough capacity on the rails, and they have a shortage of workers to actually take the cargo out of the containers and into the warehouses. So there's a whole host of inland supply chain problems that is preventing the ports from solving their problem. And right now, there are no indications that this is getting any better. So if we start to lift the eyes a little bit and look into the next year, or maybe even into 2023, what is going to happen? Well, first of all, what is very clear is 2021, carriers and also many logistics providers, they will have the highest profits that they have ever seen. Just as a very new indication, Japanese carrier O&E just came out Friday with their full year earnings expectation, and they basically expect to have almost $12 billion in profits after tax for this financial year. If we try to scale that up based on O&E's market share, this would imply that the industry might now be on track for $190 billion in profits. That would immediately sound very bad from all the cargo owners, because at the end of the day, they are the ones who are paying these very high rates. However, some cargo owners are going to benefit competitively. They're not benefiting from the point of having lower rates. They're all paying more, but depending on who the cargo owners are, some pay a lot more than others. If you are a large importer, you are likely to move cargo on contract rates that are substantially below the very high spot rates. This means the current market situation competitively is an advantage for large importers versus smallers. It's also an advantage for people that move cargo that has a very high value inside the container versus low value cargo. In terms of coming back to some sort of normality, it requires that we reduce these bottlenecks. How long is that going to take? Well, the market has never been in such a situation globally, but there is one point we can look at. That's 2015. As I mentioned earlier, because of labor disputes on the US West Coast, the bottlenecks and queues back then were about as large as we see today. And if we look at the operational performance of all the schedules and the vessels back then, we can also see how long did it then take to get back to normality. At that point in time, it took 6 months. And 6 months, that was in a period where the problems were only manifest on US West Coast. Now they're global. And it was at a point in time where the problems were only in the terminal. Now the problems are in the inland supply chain system. So not only is the timeline highly uncertain, it also appears that 6 months is if we are very optimistic. Very likely this will take longer. It's going to stretch into the second half of 2022. And there's a number of additional, you can say, unknowns in the market. First of all, this is not going to be a smooth transition. There will be a lot of ups and downs. But there's an element of demand in the system we also don't know. All measurements, all data on demand in the container shipping markets, all of that is based on measuring the containers that actually get moved. There are 3 elements there are no data for. There is cargo sitting inside containers at origin that are not being shipped because there was not space on the vessels. That is unknown. There is cargo sitting at the factories, not loaded into containers because there were no containers available. That is also unknown. And there's also some goods where the factories have simply been told, we don't want you to produce it now because we likely can't ship it. So all these three elements are unknown. As capacity begin to be resolved, as we begin to work towards normality, this could come as another demand surge. And therefore you might see a situation where you see a gradual improvement followed by another worsening of the situation. So the transition back to normality will be a choppy ride. It will not be easy. And if we start to look to 2023, there is another element on the horizon that everyone should be aware of. There are new environmental regulations coming into force. Basically, this is regulation aimed at reducing emissions from vessels, not just container vessels, but all vessels. And the precise impact right now is unknown. There is a significant risk that this might force some vessels to go slower. If vessels are forced to go slower, again, this will effectively remove capacity. Right now, there is a lot of vessels scheduled for delivery in 2023, but quite a bit of those vessels that are being delivered, some of those might actually be absorbed into slow steaming. Furthermore, because this is aimed at the energy efficiency of the vessels, this means that new and large vessels, they are very likely to already live up to the rules. However, older, which is typically also smaller vessels, are much more likely not to live up to the regulations. So we might very well in the supply chain see a situation where the impact on the major deep sea trades might be relatively small, but it might be a significant impact on the small regional and feeder trades. So intra-Asia in particular, intra-Caribbean, intra-Europe, they might be disproportionately affected by this. But part of the unknown fact here is also there is not a lot of good analysis yet, even from the carriers in terms of what is this actually going to mean, and it's only 14 months away. Finally, if we look at it, with all the cash the carriers are making right now, the question of course also becomes, what are they going to do with this? What we are likely to see over the next 12 months is container carriers that are acquiring assets in the logistics sector. Part of the problem here, of course, in the bottleneck is, if I as a carrier only move the vessels, then I can't help my customers if there are no trucks available, for example. So for many carriers, it might seem like a logical approach to acquire some more hard assets on the inland logistics side. This will not allow the carrier to move all their own cargo, but it will allow them to set up more safeguarded supply chains for some of their key clients, so they can upsell that to specific key clients and say, we can actually guarantee you space also on the intermodal side, at a price, of course. And that, of course, brings up another question. How big a role will resilience play? Here's the challenge. How much are people in the supply chain willing to pay for resilience? Right now, it appears everybody is willing to pay for resilience, and there seems to be a general consensus that the supply chain was not resilient enough. Reality might turn out to be different. What is going to transpire over the next 2 to 3 years is, in the short term, all the customers, they will build longer supply chains. They will have larger inventories. They will have longer transit times. They'll have more buffers built in, simply because they don't want to be blindsided. But once we get back to normality, it is highly questionable whether anybody really wants to pay more for resilience. Because if you continue to have higher inventories, you will find competitors start a new business that will have a more lean supply chain. So over time, this is likely to be reduced. Over time, no one is willing to pay to have too many assets sitting around just in case. So anybody involved in the market should be careful not to overbuild on vessels, on ports, on terminals, on warehouses, on all the hard assets, because in the longer term, there's not necessarily a willingness to pay for that type of resilience. What we will see, however, is an improvement of resilience through better usage of data. We have a lot of data, but they are scattered in the supply chain. A better and coherent gathering of the data will allow many of the logistics players to predict when we are approaching bottlenecks, and therefore, instead of fixing the bottlenecks, preventing them from happening in the first place. And that ties into what is basically a new competitive battle that is ongoing in the wider logistics field. On one part, we got consolidation on the carrier side. This is especially on the smaller and local niche carriers. We will see continued consolidation with the niche carriers going forward. We will either see large ones, like here MSC is buying a Brazilian carrier, or Hapag-Lloyd is buying an Africa specialist, where the major carriers want to augment their portfolio in niche markets. We will also see mergers between some of the regional players, and we may also see some of the regional players outright go bankrupt. But we will see consolidation. We will also see that within the logistics field. But this is a front where there are many different battles ongoing at the same time. Essentially, what they're all fighting for is the small to medium-sized cargo owners. So we have the container carriers that are going deeper into logistics, some of them more than others. So they're competing now head-on with some of the logistics providers. We have container carriers that go after cargo owners with new digital automated solutions. We have the existing forwarders that are also trying to go after this digital segment. Then we have digital solution providers that started out purely digital but are rapidly now building the physical shipping expertise. Conceptually speaking, you can see this as a Kühne & Nagel that was a physical player that is rapidly implementing digital solutions, versus a Flexport that started out digitally and is now rapidly building the physical capabilities. You also have cargo owners, especially large diversified cargo owners like Amazon and Alibaba, entering into the logistics services. You have terminal operators, especially DPW is a good case in point, that have acquired both regional carriers as well as logistics companies. So this is all to say there is a major battle ongoing in the logistics field. This is a battle that will likely last this decade out to 2030. And at the end of the day, what you're likely to end up with is a lot of winners, and who will then be the losers in this game? Well, the ones that are going to be most challenged are going to be small to medium-sized logistics players. They will have to either be large to compete head-on, or they will have to have a very well-defined niche where they can build barriers of entry. But a lot of, especially the small to medium-sized logistics providers, they're not going to be here in 2030. And as mentioned, digitalization is part of what drives this, but everybody here should be very careful. Digitalization and automation will not make anyone competitive in the long run. It is something you have to do, otherwise you will simply not be in the game. You will not be sufficiently productive and efficient. But coming to the point where you are digital and automated, that is just the bottom line. Where do you actually make your money? That comes from exception handling. Now, exception handling sounds negative, and sometimes it is. When something doesn't go according to plan, you need to come up with a plan B, but that's part of your service quality. How can you help your customers when things go wrong? That is going to be exceptionally important going forward. This is where the source of competitive advantage lies. So all players in the logistics chain have to have this frame of mind. You've got to digitalize, but that is not enough to be competitive or make money. Your competitive abilities and your profit is going to come from how do you help the customers when things do not go according to the normal plan. And when I say normal, what is then the new normal? Well, there are several elements that are important to keep in mind. First of all, the new normal is a market where container carriers have stronger market power than they had previously. And that is simply because of the consolidation in the industry. That is irreversible, and this is a situation that was already beginning to emerge before the pandemic. Now it's just kind of been hidden under all the disruption from the pandemic, but this is part of the new normal. In terms of vessel sizes, by and large, we have likely reached the largest vessel sizes, but these run on the Asia-Europe trades. Smaller trades than Asia-Europe, they will continue to see increasing vessel sizes. You will increasingly see, for example, 14 to 16,000 TEUs come in on the Trans-Pacific, cascading trades to ships to other trades. So that we have reached the largest vessels in the world does not mean that vessel sizes won't grow. They likely will not grow on Asia-Europe, but on all the other trades, we will continue to see increased vessel sizes. That also leads to a situation where we are likely to see a stronger concentration of transshipment cargo into fewer key hub locations. This is again a slow development. It's going to play out over this decade out to 2030. But once we get to 2030, it's highly likely that some of the major hub locations we have today are going to be much bigger than what they are. and some of the major hub locations might actually lose this game and not really have much transshipment cargo when we get to 2030. The regional carriers will see a lot more consolidation. There will be fewer of them. We will see the gradual disappearance, as I mentioned before, of a sizable number of small and medium-sized freight forwarders. And we will see the elimination of market participants that cannot make this digital transformation. Then the final thing I want to mention as part of the new normal, and that ranges beyond 2030, it goes all the way out to 2050, is a drive towards decarbonization. And if there is one positive thing coming out of the debacle right now is that the extreme profitability we see the container carriers have now also means they actually have the financial means to accelerate that drive in terms of technological development and in terms of ordering the newer and larger vessels that is required. With that, we come to an end. I thank you very much for inviting me to address you here today. I do apologize that I can't be there in person and talk to you and take your questions. I sincerely hope that will be possible again sometime next year. But until then, thank you very much for inviting me.
네, 마무리가 됐습니다.
Thank you very much for the presentation. Please give the speaker a big hand. It was the presentation on analysis and prospects of container logistics supply chain delivered by Mr. Lars Jansen. You must have many questions, and you can leave the questions in the chat room of YouTube channel. And if you are participating on Eventers, you can click the button for each speaker to leave your questions.
네, 발표 연사
We'll now move on to the third presenter of session 2. He will talk about the market trend of new builds and second-hand ships. Please welcome David Jordan of MSI through the video.
Begin by thanking KOBC for the opportunity to be here today. It is a great honor to speak at such a prestigious event alongside so many other experts in shipping. My name is David Jordan. I am MSI's director for the Asia Pacific region based here at our offices in Singapore. And today I have the pleasure of presenting MSI's latest outlook for the shipbuilding and the second-hand asset markets. For those of you in the audience who are not necessarily familiar with MSI, I thought it might be useful to begin the presentation with a short introduction. So, MSI is a leading independent commercial forecasting and maritime consulting firm that focuses solely on the maritime markets: shipping, offshore, the allied industry, shipbuilding, container boxes, ports. We specialize in model-based forecasting and structured quantitative analysis to support our clients and provide them with a sound foundation on which to build their investment strategies and monitor exposure to market risk and compliance requirements. We were established in 1985, so we've been around quite some time, 36 years. We're headquartered in London and have a regional office here in Singapore. In terms of how we support our clients, we really do this through a combination of services. These range from regular market reports and forecasting models to ship valuations and bespoke advisory services. In terms of sector coverage, it is comprehensive. Our focus today is the shipbuilding and the second-hand sectors, but we do also cover all of the markets across the shipping and offshore spaces. With that out of the way, let's get on with the presentation proper. Now, as I'm sure you're aware, the shipbuilding and second-hand asset markets are incredibly complex. Bearing that in mind and the relatively limited time I have today, the aim of my presentation is really to give you a high-level overview of developments. In order to do so effectively, I'm going to focus in on three main areas. First, I'll give you an update on the shipbuilding market and how things stand currently. Second, I'll present MSI's current outlook for the shipbuilding market in terms of contracting activity and price developments through to 2035. And I will end with looking at recent activity in the sale and purchase markets and our outlook for second-hand prices. As with other shipping and offshore markets, shipbuilding hasn't escaped the pervasive impact of the COVID-19 pandemic. If you look at new build contracting developments from a very high level, you can really split the period since the start of 2020 into two discrete phases. So the first phase was between the start of 2020 and the beginning of Q4 2020. And if we're being generous, I think the best way to describe this 10-month period would be very, very difficult at best. The second phase began with an uptick in contracting activity towards the end of Q4 2020 and which has continued into this year. This phase has been characterized by firm contracting levels and by high new building prices. Now, while this meta-narrative is largely correct, it is worthwhile examining the situation and its nuances in a little more detail. In order to do that, we need to start by looking at the past. Now, it is important to remember that fresh new build contracting had been relatively muted in the years leading up to the pandemic. After the nadir in contracting that was registered in 2016, activity did increase, but it remained at relatively modest levels. Between 2017 and 2019, average annual contracting levels were around about 54 to 55 million gross tons per annum. This compares to closer to around about 70 million gross tons in the first half of the last decade. Now, this slowdown was driven by a number of factors. The fleet was relatively young. Trade growth in certain key markets was slowing. And as we approach the end of the decade with IMO 2020 and the rise of IMO 2050, there was growing uncertainty over new building technology and over fuel choices, which were acting as a brake on some contracting level. Now, essentially, the pandemic served to amplify the factors behind this slowdown, at least in its initial stages, and at least in that first stage that I mentioned earlier. And for most of 2020, shipyards were adversely impacted. Contracting in the first 10 months of last year totaled just 23 million gross tons, which represented a decline of 45% on the same period in 2019. Now, fortunately for shipyards, again, as I said earlier, there was this late surge in contracting towards the end of the year. And overall, contracting for full year 2020 did total around about 40 to 42 million gross tons. Now, despite this last-minute recovery, overall contracting was admittedly still down 13% year on year. And it was this, in conjunction with the relatively prompt delivery of tonnage that we saw from yards last year, that resulted in the order book at the end of 2020 being equivalent to just under 10% of the fleet. Now, by this metric, the order book was at its lowest level since the early 1990s. However, that firm contracting that we saw towards the end of last year has obviously continued throughout 2021, gathering speed. And we estimate that in the first 9 months of this year, of 2021, around 72 million gross tons of new build contracting has been placed. The last time annual contracting levels were this high was 2015. Importantly, this activity has not been spread evenly across ship types. Now, container ships have led the charge, and they account for almost half of all contracting in the year to date. There's also been a substantial uptick in contracting for dry bulk carriers and for gas carriers. However, levels across other ship types remain relatively modest. At a macro level, the main beneficiaries of this ordering boom have been Chinese and South Korean shipyards. At an aggregate level, order book volumes for delivery in 2023 in both of these countries exceed last year's total delivery volumes. In terms of ship types, both countries have benefited from the spectacular container ship contracting, but in addition, South Korean shipyards have also secured most of the gas carrier orders and what limited tanker ordering there has been. Another noteworthy trend in new build ordering in recent years has been the growth in orders for alternative fuel tonnage. In 2016, just 9% of all new build tonnage ordered was equipped with some form of alternative fueled engines. In the first 9 months of this year, that figure had increased to almost 1/3, 32%. Now, LNG remains the most popular alternative fuel at present. A significant proportion of the container ships contracted this year will be equipped with LNG dual fuel engines. Elsewhere, LPG is becoming increasingly popular. There's been a substantial uptick in the ordering of vessels equipped with dual fuel LPG engines since the end of 2018. Now, it is important to note that all of these orders have been dedicated LPG carriers, where the LPG dual-fueled engines have quickly become the industry standard, in a very similar fashion to how LNG dual-fuel engines are now the industry standard for LNG carriers. Outside of LPG carriers, the adoption of LPG as a marine fuel in the wider industry has been much more muted. There's also been an increase in contracting for methanol fuel tonnage in recent years. Prior to this year, the majority of these vessels were dedicated methanol carriers. However, contracting for methanol fuel tonnage this year has actually been dominated by the series of methanol fuel container ship contracts that were placed by Maersk. As the chart on the left shows, the slowdown in contracting last year fed through into new build prices. Interestingly, however, the scale of the decline was relatively muted. Now, we attribute this modest decline in 2020 to two primary factors. First is the rationalization of shipbuilding capacity globally. Global shipyard capacity is currently around about 65 to 68 million gross tons, which is 40% below its 2011 peak. The second factor supporting prices last year was shipyard costs, which had fallen by around 8% between 2018 and mid-2020. Now, obviously, there's been this sharp reversal in price trends this year, with incredibly firm price increases across the board. We have seen particularly firm increases in prices in the main volume sectors, most notably container ships and dry bulk carriers. In addition to the strong new building interest, these price increases have really been driven by several key factors. First has been the disruption of the global economy by COVID-19, which effectively undermined the US dollar in the initial stages of the pandemic last year. This led to a dramatic strengthening in the Asian currencies, and although this has eased over the course of this year, it still does remain a factor. The second and more significant factor behind these price increases, behind these new build price increases, has been the rapid rise in steel prices. Japanese steel plate prices are currently around about 55% higher than they were in Q1 2020. Chinese and Korean steel plate prices are around 2/3 higher than they were back in Q1 2020. Because of these developments, the shipbuilding industry finds itself in rather a strange position. On the one hand, high contracting volumes this year and elevating new building prices have resulted in the total value of new build contracting exceeding $80 billion in the first 9 months of 2021. As the graph on the left shows, this is the highest annual total since 2015. In fact, many shipyards have already surpassed their original annual order intake targets for full year 2021. Initially, Samsung Heavy Industries' procurement goal in the shipbuilding sector for 2021 was $4.6 billion US. In Q1 alone, they reported orders totaling in excess of $5 billion. Similarly, KSOE had surpassed its annual target by mid-July. On the other hand, the financials at many of the major shipyards remain under considerable stress. In the first half of this year, many yards actually declared operating losses. Now, this is due to a combination of factors. You have the relatively low volume of orders in the last few years. There is also the staggered payment structure of shipbuilding contracts. The most important factor, however, has been the rising cost of steel. As a quick footnote, while I have used South Korean shipyards as an example on this slide, this is very much a problem affecting all shipyards elsewhere, China and Japan, not just those in South Korea. So whilst the short-term environment is undoubtedly very challenging for many shipyards, we do anticipate that the pressures on them will ease considerably over the next couple of years, as vessels ordered this year are delivered, ensuring a healthier flow of revenue. We also expect material costs, most notably that of steel plates, to fall as we emerge from the pandemic. And crucially, we also expect long-term improvements in the volume of new build contracting. According to our most recent modelling, 2020 is the nadir of the current contracting cycle. We do expect levels to spike this year, driven largely by container ship new building contracting, and they will total close to 100 million gross tons in full year 2021. Once the current contracting boom has played out, levels will fall next year before starting to recover thereafter. By 2026, we expect annual contracting levels will be comparable with those we last saw in 2014. There will then be another small correction in 2028 before levels once again progressively climb, this time reaching sustained levels comparable to this year's total by the start of the next decade. Overall, we expect contracting to average around 70 million gross tons per year between 2022 and 2035. This compares to an annual average of 60 million gross tons over the last decade. What underpins our optimistic outlook? The core of MSI's forecasts for contracting is an assessment of long-term future requirements for new tonnage by ship sector and by size range. From this, average annual volumes over the whole forecast horizon are derived. Now, there are two main drivers. First is the expected growth in seaborne trade. Now, it shouldn't come as a surprise to anybody in the audience that the COVID-19 pandemic remains the primary driver of global seaborne trade at present. Volumes declined by around about 4% last year. We expect total volumes to recover this year to levels similar to those seen in 2019, and then they'll continue an upward trajectory thereafter. However, longer term, there are a couple of things worth noting. First, we are expecting growth in seaborne trade, but it's at much more modest levels than we've seen in the last 25 years. Also, future demand growth won't be concentrated in the traditional bulk markets. Instead, it will be container ships and the more niche markets where we will see sustained growth. The second driver is replacement demand. Traditionally, replacement demand has largely been dictated by the age of the fleet. Despite some youthful segments, the average age of the world fleet is still around 20 years old. As the graph on the left-hand side of the slide illustrates, 12% of all ships currently in service in terms of GT are over 20 years old. This represents a large pool of potential scrapping candidates, and it'll only increase as the vessels built in the 2000 supercycle start reaching their fourth special survey. The chart on the right illustrates our robust expectations for scrapping. Near-term scrapping levels will largely be on par with those seen in the post-super boom recession. After 2023, there will be a step up in scrapping levels. In the period between 2023 and 2035, we're forecasting average annual scrapping of around 45 million gross tons. To put that in perspective, the maximum amount of tonnage scrapped in a single year in the last 10 years was in 2012, when 32.7 million gross tons was sent to the breakers. Last year, only 12.5 million gross tons were scrapped. As I said earlier, MSI scrapping forecast is admittedly very robust. As such, it is important to recognize that there are potential downside risks to the forecast. For example, further rate spikes could limit the appetite for scrapping in particular sectors at particular times. Also, with requirements for green recycling increasing, a lack of compliant breaking yard capacity could really act as a restraint on activity. However, in future, other factors in addition to demand growth, in addition to replacement demand, are likely to act as an accelerant to increase scrapping volumes. The most prominent of these are the tightening environmental regulations, and obviously the most prominent of those are the IMO's EEXI and CII. While we don't really anticipate that the EEXI will have a significant impact on scrapping levels, the CII will. To illustrate this point, we just thought it would be useful to spend a little time looking at a real-world example, so the dry bulk carrier fleet. In the graph on the right-hand side of the screen, what we've done is we've assigned a provisional CII rating to each of the bulk carriers currently in service, based on their activity and their performance in 2020. By comparing these against the required CII for 2023, when the regulations come into force, we can gauge the readiness of vessels in the existing fleet under current operational parameters. Now, it's important to bear in mind that all of this analysis is very provisional and subject to change, but as it stands, and based on MSI's analysis of the bulk carrier's operational profile in 2020, 23% of the dry bulk carriers currently in service would be given CII ratings of either a D or an E when the legislation comes into force in 2023, and as such would require corrective action. Now, ultimately, the introduction of the CII is likely to have two effects on the fleet. First, it would encourage the scrapping of less efficient tonnage, and that would stimulate new building demand. Secondly, if widespread slow steaming was adopted by the industry in response to the CII to improve vessel ratings, it will have a significant impact on additional incremental vessel demand, which will then promote further new build contracting. Let's turn to shipyard capacity. As we all know, the last 10 years have been one of entrenchment for the shipbuilding industry. Global capacity has fallen from a peak of 111 million gross tons in 2011 to around an estimated 65 million gross tons this year. Looking forward, we do expect that this year will be the nadir in shipyard capacity. It will remain at similar levels next year before increasing gradually through to the middle of this decade. This will be followed by several years of further rationalization. However, the increased demand for new buildings across the bulk shipping sectors will fuel a rise in capacity towards the end of the decade and into the 2030s. By 2035, global shipbuilding capacity will total an estimated 90 million gross tons. This is 40% higher than current capacity levels. Moving on to new build price developments. Now here at MSI, we use a benchmark US dollar per CGT price to illustrate general movements in the new build price. Overall, we do expect that the meteoric rise we have seen in new building prices in 2021 will continue into next year. They'll then decline over the course of 2023 and 2024 before increasing once again. Now, the graph on the right-hand side of the screen translates these developments in this benchmark US dollar per CGT price into average new building prices for different ship types over 5-year periods. Very broadly speaking, we expect new build prices to remain at comparatively high levels across the forecast horizon, when you compare it to what we've seen in the last 10 years. Now, let's turn our attention to the second-hand markets. Activity in the second-hand market has increased dramatically this year. In the first 9 months of 2021, close to 1,700 vessels were reported sold. This is almost double the number of transactions recorded in the same period last year, with sales volume having increased across all the major vessel sectors. The most dramatic increase in sales activity has been in the container ship and the dry bulk carrier markets, where sales have almost tripled and doubled respectively. This has been driven in part by the strong market conditions, with buyer demand firm and sharply rising prices providing opportunities for some owners to exit existing investments. Elsewhere, tanker sale volumes have increased 58% year on year in the first 9 months of 2021, despite the subdued freight market conditions, with particularly firm activity for the older tonnage. When looking at the second-hand market, there are a couple of underlying trends worth drawing your attention to, specifically relating to the appetite for ship owners in different markets to purchase second-hand assets versus new build tonnage. For example, in the container ship sector, asset market activity this year has continued to be relatively evenly spread between second-hand sales and new build contracting. By comparison, there has been a growing preference in the dry bulk carrier market over the last decade or so for second-hand tonnage. In 2018, second-hand sales accounted for around about 56% of all dry bulk carrier asset transactions. By comparison, in the first 9 months of 2021, the relative share of second-hand transactions stood at 70%. This transition to preferring second-hand tonnage has been driven by several factors. First, the bulk carrier fleet is relatively young. Second, there was a marked slowdown in trade growth towards the end of the last decade. And third is this ongoing uncertainty over new building technology and fueling choices. Given this increase in sales activity that we've witnessed this year and the improved fundamentals across markets, it shouldn't really come as a surprise that second-hand prices have increased dramatically over 2021. Now, the scale of increase has been largely dependent on developments in individual markets. For example, the benchmark 5-year-old asset price of container ships have more than doubled since the start of the year, and they are now priced at a premium to new build vessels. Dry bulk carrier second-hand prices have also increased notably, particularly for the smaller sub-vessel sizes, but they haven't increased as much as those in the container ship markets. Even tanker markets, despite the difficult conditions in the charter market, have registered modest increase in second-hand prices. In terms of how MSI expect second-hand prices to develop moving forward, it's very much a varied picture that's dependent on ship type and size. For example, we anticipate that second-hand prices in the container ship market will fall next year as some of the heat is taken out of the charter markets. On the other hand, we're expecting prices for other ship types to continue on an upward trajectory into 2022 before falling slightly in 2023. Overall, however, despite these differences, second-hand prices in the short term will be consistently higher, and in some cases significantly so, than they were in 2019 and 2020. To conclude, I thought it would be interesting to bring together MSI's forecasts for new build prices, second-hand prices, and earnings together in one place. The graph on this slide looks at a hypothetical 5-year investment, comparing different options side by side. Specifically, it looks at the IRR of various investments by ship type and size if you were to either contract a new build vessel now for delivery in 2023, or you buy a 5-year-old ship now with the view to disposing both towards the end of 2026. For tankers and bulk carriers, the better investment is in second-hand tonnage and not new build vessels. For container ships, it's generally better to invest your money in new builds, but perhaps it's just best to avoid certain sizes for the moment. And with that, I will bring my presentation to a close. I hope you found the presentation informative. We have covered a lot of material in a very short space of time. And if you have any questions, please feel free to submit them to the organisers, and I'll be happy to provide you with a full response. Many thanks for your attention, and I hope you enjoy the rest of the conference.
마무리가
That was the end of the presentation. Big round of applause, please. So that was the presentation on the trend of new builds and second-hand market by David Jordan. So we are at the 2021 KOBC Maritime Conference hosted by Korea Oceans Business Corporation.
2부
Now it's time to introduce the last speaker of the second session, and he is also the last speaker of the entire conference. With the title of Trend and Countermeasures of Maritime Environmental Regulations, we will invite Vice President Lee Hwa-ryung from DNV Global. Please welcome him with a big hand.
맞습니다. 안녕하십니까.
Good afternoon. So I didn't wait for that long because I joined after the conference actually began. And the KOBC is hosting the 2021 Maritime Conference. And it is a great honor to be the last speaker of the conference. Today, I will talk about the trend and countermeasures of maritime environmental regulations, and I selected decarbonization strategy because how we will carry out the decarbonization strategy is quite important. I will talk about this issue for the next 30 minutes. I work for DNV, and I am the Business Development Manager. In 2006 and up to 2008, the maritime industry enjoyed a huge boom. And there were many positive factors such as globalization, and the seaborne trade volume increased drastically, so we needed more ships, and we could benefit from the growth of China. And China also organized Olympic Games, so they developed the infrastructure, leading to huge increase in cargo volumes. Everything was great back then. However, the situation is similar now. However, we have two mega trends. So we have challenges and we have counter challenges. So we have the complex regulatory environment right now because, as you know, what is the current mega trend? So how we will respond to environmental issues, that is the key. At COP26, leaders around the world gathered together to talk about the agreement achieved at COP21. So at the end of this century, the average temperature will be contained by less than 2 degrees Celsius increase, and we have to try our best to contain the temperature increase within 1.5 degrees Celsius. So there is a defensive mechanism. So it was the reaffirmation of our resolution before. So we are experiencing various changes in the environment, such as typhoons, and there are many unexpected weather events. So in this complex regulatory landscape, how can we respond better? And regarding this topic, we can think of turbocharged technology and digitalization. Computerized technologies are advancing every day, and the speed of advance is very fast. And how can we tap into those technologies to respond to environmental issues? That is the keyword. And the technologies are evolving every day, and the environmental requirements are evolving every day. Although it is written in the timetable, it is becoming more and more sophisticated and demanding and challenging for us. So many market participants decided to wait. So now it is almost impossible to predict what is going to happen in the market. So there is a mixture of positive and negative factors. So it is the era of chaos. So in this situation, how can we harmonize regulatory requirements and technological development? The most important thing here is that we have to pursue the structural change. And how can we do that? In the past, we had a normal condition. However, now we are living in the era of chaos. So how can we make a strategic decision here? And it will determine whether we can build a sustainable future or not. Environment-related regulations include IMO's strategy, and we have set of requirements postulated in the timetable. As other speakers already said, we started in 2015, and we had a phase 1, phase 2, and 3, and more reinforced requirements are reflected in the regulation. But before talking about the IMO strategy, we have the agreement achieved at COP21. So in 2015, there was the Paris Agreement at the UN Climate Change Convention Committee. So as part of the meeting for the organization at COP21, as I already said, by the end of this century, we will contain the temperature increase within 2 degrees Celsius compared to the pre-industrial revolution level. And about 149 countries' leaders agreed on that. So we developed action plans, and we agreed on the action plans in 2016. And from there, actually, maritime industry was not part of the Paris Agreement. However, as you know, the IMO is a UN organization. So IMO made an arrangement to develop the strategy targeting Paris 2025 goals. That's how the IMO developed the strategy. So it is about how we can reduce greenhouse gas emissions. So here, it is not only CO2, it also includes methane and other emissions which can cause climate change. However, the IMO requirement is focused on CO2 currently. However, as you know, methane has a huge impact on global warming. So it should be included in the strategy. And at COP26, methane was mentioned. So let's look at the timeline. The bottom line here is that by 2030, carbon intensity should be reduced by 40% compared to the 2008, which is the base year, and it should be reduced by 70% by 2050. And by 2050, compared to 2008, the total industrial emission, regardless of the total cargo volume or number of vessels, the total CO2 emissions from the maritime industry should be reduced by more than 50% compared to 2008. That is the initial IMO strategy. And in 2018, based on the Paris Agreement, this strategy was developed, reflecting the situation back then. However, it also has the potential to change. In 2023, we will review the strategy once again, and we will evaluate whether it will contribute to the 2 degrees Celsius temperature increase limit, or there is a possibility to change this strategy into a more stricter one. So we have EID and energy efficiency indicators, which will be conducted by 2023. And from 2023 until 2030, as you already know, EEXI requirements will be adopted. So this is for existing ships. And existing ships should go through retrofits. And CII, carbon pricing, low carbon fuel plans will be carried out during this time frame. And in the long term, we have to target the zero carbon society. And we have to reduce 70% of carbon intensity and 50% of total emissions. That is the plan. So up until now, the IMO has presented the strategy and the industry developed various action plans. So these requirements have been already reflected since 2015. And toward 2030, we will have more and more requirements which will be reflected in the industry. In addition, in the past, when the IMO has requirements, we could just prepare for the requirements, but we could take time. It was mostly 2 to 3 years, and we could deal with it. However, now we also have regional government activities. So they set up even more demanding requirements compared to IMO strategy. And they present even more active plans. And at the European Union, they have even more demanding requirements compared to that of IMO. So if we want to operate the route in Europe, we cannot neglect this. So the shipping lines and the shipyards have to prepare for these regulation changes. And not only EU, even in the commercial sector, there will be carbon trading system. And there is a huge difference between EU and companies. So when there is a carbon trading system, it will have a huge impact on our design and operation. So in the past, IMO was the center of regulations and policies, and we only cared about IMO. However, now we have parties such as the European Union and even local governments. They have their own requirements. So they developed ECA and SECA and other emission limits. So before, we could just concentrate on IMO to reflect the requirements in our design, but we now have more various requirements, and now we have to think about capital. The financiers would like to improve their reputation, so they would like to provide funding to companies who would like to contribute to environmental pollution prevention. The Poseidon principles are targeting Europe and the US. So 18 bankers present more demanding carbon-related criteria, and it will be implemented starting 2023. And it was started with 18 bankers, but now it has the member of 28 banks. So that means we have to reflect their requirements when we design ships, because finance is one of the most important factors to operate ships. And now we even have cargo owners such as IKEA and Walmart. They set 2023 or 2025 goals so that they would like to move their cargo with eco-friendly vessels. These all have impact on the industry. So if we would like to have a business there, we have to reflect the requirements. This is the case for us. We have to think about third-party requirements even more than IMO, because they have a more demanding criteria. In the past, we could just design ships and operate the ships based on IMO strategy. However, now we have many more players who impact our operation. And this is the Energy Transition Outlook, which is independently published by DNV. So how the energy system will change until 2050. So about 150 engineers worked on this project. So to satisfy environmental requirements and in order to respond to the changes in the environmental landscape, how can we change the energy system? That was the topic of this publication. And in case of Korea, at least 50% and up to 70% of electricity comes from fossil fuels such as coal and LNG and oil. However, in 2050, it will completely change. We will have 12,000 onshore wind farms and 5,000 offshore wind farms, and we will tap into photovoltaic plants. This means that renewable energies will take up a much more portion for electricity in the future. What does that mean? When you think of the fuel option for your vessel, you have to adopt low carbon or zero carbon fuel. So we can think of e-ammonia or methanol And we have to produce energy and electricity through renewable energy source. They are regarded as a zero carbon electricity. So this will be the platform to supply zero carbon fuel for us. So as the population goes up and the GDP goes up, in the past we used more energy, but that's the past. Now, energy usage level is flat because we might consume more electricity, but now we have a higher efficiency. So energy consumption in total is not changing much. And CO2 emissions have gone down after energy consumption. So we are changing fuels and we are advancing technologies. So we can reduce the CO2 emissions thanks to this decoupling. And it will be true for the vessels as well. So if you have the coupling effect for vessels, if there is more seaborne trade and if it increases the CO2 emissions, it will not be sustainable for our 2050 target, which should reduce 50% of CO2 emissions and 70% of carbon intensity. That's not feasible. So there are three major fossil fuel energy sources such as oil, coal, and natural gas, and this is the outlook of a production. In case of coal, it peaked at 2013, and the usage has reduced by 1/3. But although coal is the major culprit for CO2 emission, we have to use a certain level of coal, but it will decrease gradually. The same goes for oil. The peak was 2019 and it is decreasing. However, in case of LNG, it is a relatively clean fuel, so it will be used more than oil by 2030. So it will be the most widely used fossil fuel in 2030, and it will maintain the position until 2030 and 2050. But it will be replaced by zero carbon or low carbon fuels later. For example, it will be replaced by hydrogen. In case of seaborne trade, we will see an increase in cargo volume because we have a bigger population in the world. So the fuel demand will maintain. So oil cargo and oil product cargo and bulk carrier, they will maintain the similar level, but LNG and bulk carrier, bulk cargo, container cargo will see a drastic increase. So we can have a long-term prediction which sector will be still active in the future. Then we looked at the change in the fuel mix in the future. The portion of oil will decrease. It will be used by 2050 still. However, it will go down drastically up to 2050. That means new building using oil, the number will decrease drastically. In case of LNG, depending on technology we use, we can still use it as a major fuel. And what is interesting here is low carbon fuel. It includes a zero carbon fuel as well, and they will be widely used starting 2040. So ammonia And hydrogen has its own limitation, so it might not be used for long haul or ocean-going ships. And if you are a domestic operator, you can look at hydrogen as the most viable fuel option along with the battery. So now we have the challenge of EEXI and CII, and it will be adopted, it will come into force on January 1st of 2023, and you must be familiar with the content. We have EEXI and CII. And what does EEXI mean? Since 2015, for every new building of ships, we applied EEDI, which is Energy Efficiency Design Index. However, there was no requirement for existing ships. However, starting 2023, there will be the same requirement applied both to the existing and new building ships. So it is about retrofitting the existing vessel. And there was a discussion in the industry. How can we reflect this in our fleet and what kind of actions can we take? It was the huge topic recently. And this is the sample study for one fleet. And the existing ships in operation, they do not have exact statistics. So we have to use estimates. And for EEDI, so the ships delivered after 2015, they have EEDI figures. And we also have EU MRV figures. We calculated based on the report. And since 1997 and up to 2022, we calculated the estimates related to EEXI for ships delivered during that time frame. And for old vessels, it is hard to comply with EEXI. So the ships which is over the dotted black line, they should take some action to comply with EEXI. And they need small or big action to comply with the new requirement. This is one example. The easiest way is to reduce engine power. So if you reduce engine power, it will reduce emissions. So we can recalculate the figure. So to satisfy EEXI, so it was delivered in 2015, but they can just reduce a small amount of engine power. It does not generate any huge problem. However, what about this? It was delivered in 2008. They have to reduce this much engine power. It is still possible because this is the speed profile in 2019. Sometimes it operated at a higher speed. Sometimes it was operated at a mid or lower speed. But if it is over 14 knots, they cannot now use the engine power. They have to operate at lower than 14 knots. But as the previous speaker mentioned, it will reduce the speed. In that case, we need more vessels. That is the weak point of the current requirement. If we need to operate more vessels, it will lead to additional emissions. But there is no clear definition from this side. But still, we need to satisfy the EEXI, so we have to operate the vessels at a lower speed. That is the strategy viable for the industry. So that is the reality So for each an individual vessel, we have to conduct a review, and we have to set engine power limitation. And if it is possible to satisfy EEXI with a lower engine power, we can be certified. However, if that is not possible, we need another strategy such as engineering, or as mentioned before, if it is not possible at all, we have to scrap the vessel. So with the new requirements, depending on the cost and vessel age, we have to make a decision. If we carry out retrofit, we need to redock the vessels. It requires additional engineering activities for shipping lines. And let me talk about CII. EEXI is related to design, so it defines the size of engine, and it determines the feasible deadweight tonnage. So if it is decided for good. However, CII is different. It has a base performance, and it will be different depending on the operation. So how can we operate the vessel in an excellent manner to satisfy CII requirements? That is the challenge for shipping lines today. So in EEXI, we looked at the different fleet, but now we apply the CII. So in the total operation period, how much fuel was consumed and how much cargo was carried. These are the two factors to calculate CII. And we have a Poseidon principle. 28 signatory bankers developed this principle, and it has the limit of dark blue square. But as time goes by, these requirements become even more tighter. So in 2025, it has this level. However, in 2030, the bar will be even higher. So depending on the operation performance, the acceptability will be different. So performance is key here. But with the time, the requirements become tighter, so it will have a less asset value, so it is destined to be scrapped. So requirements are becoming more and more demanding with the time, as you see here. So it is about carbon emissions. So we have to operate the vessel at a lower speed. So they have to convert to lower speed now based on CII. But as I said, if it is operated at a lower speed, we need more vessels. And the delivery schedule will take more. It also means additional emissions, but there is no solution for that. If we cannot satisfy CII, it is hard to find a better solution than this. So in 2023, we have A, B, and C rating, and if you have D and E rating, you might not be able to operate your vessel. But in 2023, my ship is at A grade. However, in 2030, it might not be the case. My vessel will be graded to B, C, or D. So in 2023, it was A rating. However, for the same vessel in 2030, there will be a much less vessels which can fall into A grade. So this is the change we will witness. So A and B grade vessels can operate without any problems, but in only 7 years, they might face the problem where they cannot operate the vessel. They were supposed to use the ship for 20 or 30 years, but if they have to scrap the vessel after only 7 years of operation, that is the problem. And this is the reality we are facing. As I said, we have many additional requirements such as CII. So we have to evaluate the performance every year, and we have to check which grade the vessel falls in every year. And in the past, we had HL4. However, it is not relevant anymore. And sulfur oil and MGO are now included because there is a sulfur limit now. Now the option is that we might have to think about whether we will go for LNG, LPG, methanol, hydrogen, or ammonia. So we have to evaluate all the alternatives included in the table. And engineers should do that. It requires additional engineering work at an initial stage. So this is the new era as well. In 2019, LNG and methanol and battery were considered alternative fuels, but it was adopted by only 6% of the new building. However, the portion has increased. This is the global record. When we only look at the Korean shipyard, in case of Daewoo, it is 66%. And in case of Hyundai, they have won so many orders, but LNG fueled ship or LPG fueled ship, the share of them are almost 50% at Hyundai shipyard as well. So we are already witnessing the new trend. Before, ship owners were reluctant to reflect market volatility. However, now they are actively adopting alternative fuels in their ships. Ammonia and methanol are still emerging because they are zero carbon fuel. And we have to prepare for adoption of such fuels. And when we considered HL4, my vessel is D grade before 2030. However, with H4, this vessel can never have A grade. And when we adopt LNG fuel, low carbon fuel, it can operate until 2035. And for LPG, we have an even longer period. So depending on alternative fuel we adopt, the CII grading will be different. So that is why we have to make a better decision at an earlier stage. So if I would like to be a high-end charterer, I have to set a high bar for my vessel. So if you adopt a DFLNG, the validity will end around 2035. However, according to the IMO requirements, you can still use the ship until 2040. However, if you adopt conventional fuel, you cannot operate the vessel even before 2035. So why do we have to convert to alternative fuel swiftly? This slide explains the reason. So when I newly built the ship, it was okay, but with the adoption of CII, I might be facing the situation where I cannot use the ship any longer, although it was not operated for a long time. In that case, I have to develop decarbonization stairway. What kind of action I will take to lower carbon intensity so that I can extend the period of operation. So you have to plan this at a new building stage. And you have to work with shipping companies and shipyards. And as a result, although it is not guaranteed, you have to deal with carbon risk. And you have to be aware of the lifetime performance of the vessel. So it is a whole different situation now. To improve decarbonization performance, we have various pathways. We need to think about machinery. But to reduce carbon emission, the ultimate option is to change the fuel. So this is about the fuel combination. And for new buildings, to have a fuel flexibility. So during operation, you want to repair or retrofit your vessel so that you can maintain a good grade. In that case, you have to prepare for that in the design phase. So right now, for new buildings, we never design ships for the short-term operation. We have to consider the full life operation and performance. So that is a better investment decision now. So let me summarize the presentation. So we have more and more regulatory pressure on shipping and carbon emissions. Now it is only about new building or purchasing ships. We shouldn't think about the current price. We should think about the lifetime performance based on engineering analysis. Already we are witnessing fuel transition. LNG and LPG are the most viable and practical options for now, but in the future, low carbon or zero carbon fuels will be around. And we have to consider risk when we make a decision on fuel transition. And although we have requirements right now, we do not have a clear framework and we do not have best practices for the industry. And at this point, all of the parties in the industry should pool their wisdom to find the best practice so that we will never waste our investment in new building. And in conclusion, there is a higher engineering pressure, so we have to consider alternative fuels, and we have to go through digitalization utilizing various technologies. So although shipping companies and shipyards, no matter how large they are, they have to collaborate with other parties at the industrial level. So I believe that I'm behind the schedule. I know that everyone is in different situations. The situation is different in Russia and India about decarbonization, so they have different opinions for the regulation. And each company might have a different situation, whether you are a domestic operator and deep sea operator. You have to develop your own strategy based on the current status of your fleet. And you have to take action swiftly. That's how you can cope with the current era of chaos and uncertainty. That's how you can maintain the leading position in the market. Thank you for your time today. And this is the end of my presentation. Thank you very much. Thank you very much. Thank you for the presentation, Vice President Lee Hwa-ryong. So we have many questions. So could you please stay for the Q&A session? So due to a time limit, we will ask only 2 questions. So it is a question from anonymous person. So what is the most effective carbon reduction technology for ships in the market, including CO2 capture mechanism and air lubrication system? So you said that ships in operation, so CO2 capture mechanism and other technologies. So in my opinion, if it is the ships in operation, they do not have many viable options for techniques to reduce carbon emissions. However, the easiest option is, depending on the vessel, you can just reduce the speed of operation. So you can set engine power limitation. It is the most realistic approach. And if you decide to go to retrofitting the vessel, CO2 capture could be the most realistic and viable option. It seems like that. However, I believe that we need some time until commercialization of such technology. Some advanced shipping companies in Japan are testing this technology. However, until commercialization, we will face many barriers such as space and interoperability with the existing system, and even the ways to maintain the captured carbon. So we have so many unproven parts of the technology. So that is why for ships in operation, you can think about EPL, or you can think of a fuel switch. So it is a similar question. So in case of European ships in operation, are there many cases who are engaged in retrofitting away from diesel engine toward eco-friendly engines? It requires a huge investment, so it is not that easy. However, in the industry, leading companies, in particular BW Gas, which is the LPG leader, before it was HPO carrier, but now they are converting to LPG, and they are doing that right now. And it could be one example. However, after adoption of CII, although they have enough vessel age, there might be some vessels which face the limitation due to CII. In that case, they have to make retrofitting investment, and they have to compare asset value, and if they still find it feasible, they can retrofit their vessel. So due to a time limit, we will just end the session with 2 questions. Thank you for your presentation. Once again, please give the speaker a big hand.
자, 이렇게 해서 오늘
So with this, we have completed the official conference. I hope it was beneficial in understanding global market trend in the shipping industry and respond to changes in the market environment. Under the theme Post-Pandemic, the Path to Take, we have diagnosed the changes of the present era and also give an outlook for the future. So with this, 2021 KOBC Maritime Conference is closed.
한번 말씀드리겠습니다. 오늘 이벤터스 웨비나 페이지에서 만족도 조사 함께하고 있습니다. 선착순 100분에게 선물도 드리고 있으니까 오늘 행사가 종료되기 전인 6시 30분까지 창을 열어놓도록 하겠습니다. 더 좋은 컨퍼런스를 위해서 여러분의 만족도 조사 꼭 부탁드리겠습니다. 참가해주신 국내 참가자
So thank you once again for your participation, and with your big round of applause, we will close this conference. Thank you.